All right, guys. Good evening, professional traders and professional investors. Welcome to day two, right? Welcome to day two. Hope you guys, enjoyed yesterday's class. So, welcome to day two of our training, journey. Today we're going to kick off from here. So, trading. We're getting into the meat and potato, to the heart of things, right? Yesterday we talked about a couple of things. Just a quick 1 minute, high level. How and what we trade, how they get on these exchanges, right? Companies. We started from there. I love to start off with that so that we can build some solid foundation. Why we trade what we trade, right? And why are they there? How did they get there, right? So yesterday we started. We kick off with that companies, IPO, stocks, etc. Markets, a little bit of market structure information in there. But today we're starting from here. So the goal of this trading is on trading, right? So what is trading? Trading is the buying and selling of financial instruments, right? Of financial instruments, like stocks, futures, commodities, currencies and bonds, right? With the goal of making profit. So when we get on there, our goal is what? To make profit. Our goal is to make, profit. When we get on there, our goal is to do what? Is to make profit. Um, Traders make money by what? Capitalize on price fluctuation, within the market, right? We want to see that price is moving up and down. That is what gets us, the kind of traction that we are looking for. And then we are able to what, to trade as well, right? We look at that and then we trade with this, the price action by looking at how the market is going. We say, oh, okay, there's opportunity right here. Let me go ahead and grab it, right? So unlike long-term investment, typically when it comes to, investment, which focuses on holding a certain asset, right, for years. So here you have friends. The friends might say, "Hey, I bought Tesla stocks," and what are they doing? What is their mindset? Their mindset is that they will hold on to their stocks, and then hopefully the value of their stocks will appreciate, right, with time. So they buy Microsoft stocks, they buy Google, Apple stocks, etc., etc. They buy all these company stocks, and the hope is that one day, we will reap and share in on the future success of these companies that we hold their stocks, right? Unlike long-term investment, trading is very different, right? Trading is very different. So trading, we're looking for short-term opportunities, right, in the market. We are not interested in buying the stock and then holding on it and hanging on to the only strategy. The strategy is called hope, right? And hope is not a strategy, right? Holding on to that and then thinking that one day, the stock price or whatever that we are holding, positions that we are holding, will appreciate in value. Here it is different, right? It's very different. When it comes to trade, it's very different. We just look at whatever that is happening. It doesn't matter whether it's going up, it's coming down. We look at the price actions on the chart, and if the chart looks good for us, we can scalp, get in, and take some action. That's it. We zoom in and take an action, right? That is what trading is about. Trading is about looking for opportunities right in time, in real time, right? We are not looking to hold 1 year, 2 years. Hopefully the price, will go up and then we'll make some money, right? So that is what trading it's about. That is what trading is about. When you look at the market, when you look at the chart, yesterday we look at the chart, and I'll be bringing the chart, intermittently. I'll bring in the chart over here on the screen. When you look at the chart, see, the art of trading is driven by people, actions of people, right? Some who want to buy an asset and others who want to sell. This constant interaction, right? This constant interaction between buyers and sellers is what creates price movement, which is represented by candlesticks on the chart, right? So let me bring the chart here quick, so that I can use this as an example, right? So when you look at the chart, all the red, just like yesterday, was it yesterday? Yes, yesterday. Um, uh, all the things that we see here, on the chart. Let me share this screen here. It's my Firefox. All right, can you guys see this screen here? The chart, everything that we see over here, when you pick up any security, you pick up any asset. Yesterday I talked about it. That it's all about buying and selling, right? Buying and selling. People want to buy, people want to sell. Red candles, green candles, etc. Right? It is the interaction, constant interaction between what buyers and sellers. It's what is creating this movement, right? Creating this movement that we see out here, forming all these, candlesticks, right? All these candlesticks you see over here, in a lot of ways, represent individuals, retail traders, right? Institutional traders, right? They represent people, right? I want you to see these candlesticks as individuals. People are all over here, right? If I can bring some emoji over here, I can bring some human beings, over here to come and represent us, you know. To to come and represent us on this chart, right? That there are people and human beings all over the place, right? The actions over here, the red, the green. Some engineers are here. Some people are trading right here. Emoji says, they will not let me use them like that unless I pay. All right. So there represent a lot of people over here. This represents a lot of people over here taking different actions on the chart, right? Let me try and bring people over here. Some are excited. Some are buying different things. There are a lot of people over here. All these actions over here, represents people. Some are buying, some are selling, and doing also all kinds of things over here, right? So, the act of trading is driven by individuals, driven by people. If you want to personalize it, it's driven by us, right? Because we are the people that are selling, right? We are the people that are selling. We are at different level, whether down here, whether up here, whether price come down here. It's all people over here. I want you guys to look on the chart, or look at the chart as if it's individuals right there. But they are being represented here by what? Candlesticks, right? Candlesticks. Trying to look for more people over here to fill this price chart, So it's all human beings, right? Human beings are all over the place, right? It is people, guys. People, people, people. This is Mr. Beer. He's got a lot of mustache over here. He's also buying. I want us to, see it like that, right? People. Some are selling. There's a young graduate. The mom gave her a graduation gift. Then she came to the market, right? You can see that the graduation gown, right, and the cap. All right. So the market is driven by people, right? I love this. I've not done that this before. I love this, right? So driven by people. There are individuals all over here. Every candlestick we see over here is represented by somebody, right? It could be a lot of people, put together in that one candlesticks, right? That's a lot of people taking actions over here, right? So the interaction between buyers and sellers, this is what is creating, the candlesticks on this on this chart, right? That we're looking at. At any given moment, if buyers are stronger, that is when buyers are stronger and they are more aggressive than sellers. The price, than the sellers, then the price goes up, right? So like this gentleman over here, as you guys can see, once you take a look over here, you see that more buyers. There's a explosive, right, green candle, right? There's explosive green candles over here then what that means is what? That means there are a lot of buyers than sellers, right? That we have a lot of buyers than sellers over here. And then when you see, explosive, red candle drops, right? Explosive one, right? Explosive, strong, red candle. That means what? That means if sellers are stronger than buyers, then the price goes down. So this is what we see over here. That means there are a lot of sellers than what buyers, right? The sellers, they've exhausted, right? They've exhausted the buyers. They've overwhelmed them, right? The sellers have overwhelmed the buyers over here. And then here too, you can see that what? The buyers, they are pretty much, they've overwhelmed the sellers, right? They've dwarfed them, right? Sellers went to zero, but there are more willing buyers over here than sellers. The same thing over here, So everywhere that you see on the chart, right? Everywhere you turn, you see on the chart, see green candles, you see red candles. It is a representation, right? It is a representation of what? Of buyers and then what? Sellers, right? On the chart, right? So this is what makes what the market moves. Let me flip back over here. This is what drives the market, guys. This is what makes, the market move, right? This is what is moving the market, buyers and sellers, which is largely represented by what? Candlesticks, right? Candlesticks on the map. Now, before we get ahead and say let's go ahead and let's start trading, let's start something, let's start buying and selling. No, not too fast, right? Not so fast. Not so fast. There are mistakes. This trade, I want to kick off with us with risk management, because the goal of our trading style, all of us here, after this trading and wherever we find ourselves, we start trading. The goal is not to make money, but is to preserve our capital and even make more, right? And so what is the most important thing then? It's about risk management. Our goal every day when we wake up, we come to the, we come on our exchange, we come on a platform, we want to trade. Our first goal, right? Our first goal is what? Preserve our capital. We want to preserve our capital, right? But there are six novice mistakes, six novice mistakes that I want to talk about, right? Things that, beginners, hey, this is good news for us, right? This is good news for us. People have done this over and over for decades, right? Decades, years. And so we are able to learn from their mistakes. We don't want to commit the same errors, the same blunders, that they committed, when they were starting out, right? And so there are mistakes that, essentially we can learn from, right? So that we don't do the same thing, right? The number one mistake that beginners, right? Beginners always make. Traders, beginners always make. Number one is what? Number one is trading without a plan. Trading without a plan, right? Trading without a plan. Entering trades without a strategy, a clear goal, and this is very a big one. And why it can harm you is that it leads to emotional decisions, right? It leads to emotional decisions, inconsistency, confusion, during market swings, right? And how are we going to face this? By, build and follow a clear trading plan with a defined entry, exit, and risk rule. Yeah, everything I've written over here, some of them from real life experience, right? From my own experience, without a plan. 2017, when this journey, started, I made some terrible mistakes. I lost a lot of money, over $50,000 to $60,000, right? Why? Because, it was all emotional decisions, right? Or just making decisions based off emotions. Buy this, buy that. There's signal here. This is moving up. Can you buy this one? This one is gonna go straight to the moon, right? It's like somebody telling you that go and buy Bitcoin. It was at 5,000, 10,000, now it's at 100,000. Guess what? It's at 100,000. Potentially can go to 1,000,000, but guess what? Potentially can also come to what? A zero, right? Right? Bitcoin is at 90 something thousand right now. Currently, I don't know the price. It might be 80, it might be in the 80s or something, right? Emotional decisions decisions, right? That was what I was just doing, right? Because I didn't have any strategy. I didn't have a strategy because it was just basically based on what? Emotions. That was me, 2017, 2018. Right? Buy this, buy that, buy this coin, buy this alternative coin, buy that, buy this one. This one is moving, right? There was no plan. I didn't have any plan. There was no plan, and that is terrible, right? So personal experience here. I'm sharing some personal experience here, guys. I said it yesterday, guys. I want you guys to. I'm going to keep saying that. I wanted you guys to internalize it. The first mouse always get the trap. The rest of the mouse they get what? The cheese. So I don't want you guys to get a trap again, right? I do not want you guys to get into the trap because there is danger ahead, right? There is danger ahead, right? And so the first thing that we're going to do is what? We will have what? A trading plan. We got to have a plan. We got to have a plan. We're not going to stay in and then, blow our account, for no reason. So number one, we're going to have a trading plan, right? That's number one. Number two here, novice mistakes, right? Novice mistake, guys. Before we get into chatting, we start trading, we start doing all the fun things. No, I want us to internalize this. I want us to get this into our bloodstream, right? Get into our systems, right? Risking too much on one trade. Risking too much on one trade. Have you ever seen, for folks that are joining outside of Ghana, maybe you guys are familiar with this. In America, there are big, lottery, right? Now, when people stake the lotto, and then sometimes they win big money, right? Win big millions, several hundreds of millions of dollars, in the lotto. When they win the lotto over here, what we have found also is that the same people that win the lotto, what happens to them? About 7 years, 6 years, that they become poor again. What, right? Become poor again. Now, what is the lesson here? The lesson here is that no one trade is going to change our life forever. That we think that there's nothing ahead of us again. We're not going to put all our money in one trade and say, this one I'm putting all my life savings in. This one I'm all in. If it wins, bingo, my life has changed forever, right? No, we're not going to do that. Going all in on one single trade, hoping it hit what? Big, massive, right? We want massive results. And we say that, we're using all our life savings, everything that's in our account. 10,000 Ghana cedis, 20,000 Naira, 50,000 pounds, $20,000, 30,000 Canadian dollars, wherever you find yourself, wherever you're watching this, right? Maybe 100,000 rupees, go all in, right? 200,000 maybe Kenyan shilling, whatever money, that's, it's your currency. You're not going to go to your bank, withdraw all your money and go and put it into one single trade because you think that you've seen one good strategy and this one, is going to solve, your generation and the generations to come and all your forefathers and your grandfathers and your parents, every problem that they have, right? We're not going to do that. We are not going to do that, right? Risking too much in one trade. We're not going to do that, right? And it can harm us as well. One bad move can wipe out your entire account. One bad move, right? We're not going to do that. This is why I'm starting off with this, right? I'm starting you guys off with this. So how are we going to trade? We're going to trade by risking only what? 1 to 2% of our capital, whatever money that we said we're going to start trading with. Every trade that we're taking, we're going to be risking what, and we will take a deep dive into this proper, maybe some other session. Maybe no, it's not going today. It's not going to be next week. But I'll have time to, show you guys with a spreadsheet how, we'll break down our trade. So if a day, we say that a day, our risk is maybe 1% of our account, 2% account. That means if we are taking maybe 3 trades in a day, we will split the 1% for 3 trades. That's what it is, right? We will go with rules, guys. We need rules around us. We need rules around us. And I don't expect anybody here in this my class to bend the rules. No. We need the rules because I don't want you to come and tell me that, that I blew my account. I did this and I lost my money, all my money. No. We're going to build wealth incrementally. Why? There is always money in the market. There's always money in there. So we're not going to. Our mindset is not like, if today we don't get in and go on this trade with all our life saving, the world is coming to an end. No, the world is not coming to an end. Tomorrow the market is going to be there. The day after tomorrow the market will still be there, right? Right? So we're not going to do that, but there's always money out there. There's always money out there. I show you guys a trade that I did not take because I was running a little bit behind with dropping off my kids on Friday morning. When I came back, I felt a little bit bad that, hey, I should have taken this trade, this gold trade. But I don't have to feel that bad. Why? Monday is coming. There's going to be money out there again, right? In the same asset, the same security, in the same, a product or whatever commodity out there. I can still trade it, right? There's going to be opportunities out there every day. So we are not going to risk too much in one trade, guys. I'm starting you guys off with risk management, right? With this, right? This is very important. I want us to internalize this within us, right? And then number 3, among the 6 novice mistakes, right? Number 3 is what? Ignoring risk management. Ignoring risk management, right? What is the mistake here? Not using stop losses, right? Or ignoring the reward to risk ratio, right? Not using stop loss. There's something called stop loss, and I'm going to dwell on this a lot, right? Stop loss. You will have to take it. Every trade that you take, there has to be what? Stop loss. Don't remove the stop loss. That's how you blow up your account. It's going to be seconds, right? It's going to be gone. Your money is going to be gone just like that. So not using stop losses, right? Not using stop loss. You have to use a stop loss. I'll show you guys what a stop loss is, right? Very soon. You guys will become very familiar with stop loss, right? Stop loss. Stop loss, stop loss, the meaning or definition is in the word itself. Stop loss. The loss must stop. Right? The definition of stop loss means what? Stop loss. The loss must end here, right? Must end here. I don't want to spend more than this, right? If the trade goes against me, stop loss, right? This is very important. Without risk control, small losses can turn into account killers, right? Without risk control. So we will use what? Stop loss, right? We'll use stop loss, and then we'll aim for our reward to risk, ratio at least, 2 to 1, 3 to 1, 5 to 1, 3 to 1, 2 to 1, depending on whatever we're trading. But we'll make sure that we always have what? A stop loss in place. A stop loss in place, guys. This is very, very important. How many of us are going to use stop loss? I want you guys to type in the chat right now for me. Stop loss. I want everybody. I want to see in the chat right now. I want you guys to type stop loss, everybody. I want to see that, everyone, so that I know you guys are following, and we're going to be following this rule, stop loss. Now, I want everybody to type the word stop loss in there, stop loss. I want to see this from everyone here. Stop loss. That means that you are here, you are listening, you are participating. Stop loss, everyone, right? This is very important. This is very important, guys. Stop loss. The loss must stop here. This is all that I'm trying to risk. $50 is what I'm trying to risk. If it goes against me, I lose only $50. I'm not going to sit down and lose 100, 300, 500. No. If the trade goes against me, stop loss should take me out, right? 50, that's it. Stop loss, right? Guys, this is very, very important. This is very, 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 very important, guys. Stop loss, right? All right. Number 4. Everything over here, guys, I've experienced it myself, right? I've experienced it myself. Number 4 over here, novice mistakes, right? Novice mistakes. Overtrading. Overtrading, guys. Overtrading. Right? Overtrading. Taking too many trades in a day. No, we're not going to be here sitting down and taking 5, 6, 8, 10 trades in a day. No, taking too many trades, what? In a day. Often out, out of boredom. They are sitting down, let me just go and do something, or maybe out of greed, right? When the market gives you something, that's it. Close your laptop, and then be done for the day. I know this is going to be very hard, and I know even today, for even me, I struggle with this, and I have to be disciplined sometimes to say that I'm done for the day. Over trading. Over trading means that sometimes when you start a trade in the morning, you get good money, $500, maybe $1,000. By 10 o'clock, 11 o'clock, you've already made $1,000, right? And then guess what? Out of boredom, you are sitting down. They say the devil finds work for the idle hands, right? Is that not what they say? The devil finds work for the idle hands, right? You be saying that out of boredom. Before you know it, you have already entered in a trade that you are not supposed to, go into, right? You've gone into a trade that you're not supposed to get in. You have no business going to that. If you have a trade plan and your trade plan says that, your daily goal is $100, $50, $500. If you've made that money, guys, be out. Come back tomorrow, right? Be out. That's it. You're done for the day. But over trading, and this is what happens, right? I'm going to tell you guys because I've seen this personally. I've done this personally, right? When you have about two winning trades in the morning, right? It's like your mojo, right? It's like, you become a little bit cocky, right? You guys know the bird called, cockapine, or the is that a cockapine or something? You become like that. You are the tough guy. Everybody should leave you because you're winning. You're on a winning streak, right? You win one trade, the second trade goes well for you. Third trade goes, today is a good day, right? Today is a good day. That's what is going to come into your mind. You say, today is a good day, but it is danger ahead. It is what? Danger ahead, right? Because what is going to happen is that you will give back all the money that you've made for the day. If you keep trading, you're going to lose, and then you give back the money that you've made. So if your goal is that you want to make $100 a day, $500 a day, whatever your trade goal says that you're doing, you need to stick with that plan, right? Your plan, your plan should permit you or should allow you if it has to allow you. If your plan does not permit you, you have to tell yourself. I learned from one of my mentors. I met him, Tanjo. I met him. And when I met him and we were talking about trade and different things out there in some coffee shop, right? And when we were talking, and then there was a trade that was we all could see a potential trade. And I said, would you take it or not? And he says that no, his trading rule will not permit him. I'm like, permit you a trading rule that you've written down, you take instruction. I said, yeah, my trading rule will not permit me to take this. There I learned right away, right? That was a big lesson for me. I'm like, wow. So, when you have rules written down, the rules, you should be guided by the rules all the time. You say, yes, if he's down for the day, he's down for the day. That's it. He's not going to trade again. I'm like, wow, this is so good, right? This is so good. So, by trading too much, guys, it's going to lead to poor quality trades, emotional fatigue, and higher transaction costs, etc. You're gonna do so many things that you're not supposed to do, right? So we're going to be very selective. If we are taking two trades, three trades a day or whatever, we focus on it. Our focus is on what? Quality setups, not quantity, right? Our focus is on what? Quality setups, right? Quality trade setups, right? Not on quantity. We are not interested in saying that, oh, we've achieved so much today by taking 15 trades, maybe 10 trades, 8 trades, whatever. If your rule or your trade plan goal is 2 trade in a day, that's it. Or 1 trade, 1 quality trade in a day, that's it, right? So over trading, guys, personally, I've seen it, when I start making money and I start trading more, like I said, then I start losing money because I'm over trading. I'm over trading, right? I'm over trading. It's going to burn you, right, guys? It's going to burn you. All right, number 5, chasing the market. Chasing what? The market. FOMO. FOMO trading, right? FOMO. FOMO trading. What does FOMO means? FOMO is an acronym. FOMO means fear of what? Missing out. Fear of missing out. How the trade is going, you're going to make money. On Friday, I showed you guys a trade on gold that I could have gotten in, right? When I came back, because I usually do the case, like maybe it takes me about, 30 minutes, 45 minutes, I should be back home, right? When I draw the case off from school. When I dropped them off, come back, and then I came back and I saw my gold trade. Let me show my screen. When I show it, it was already on its way down. I could have jumped in on that trade, right? Fear of missing out and say, hey, I'm not going to miss out on this, right? I'm not going to miss out. When I show you guys this trade, on Friday, let me bring it up here. Hopefully you guys can see my trade, right? When I show you guys this trade, that, potential trade that I should have taken on Friday on gold, right? On gold. This trade that I should have taken on gold, right? When I came in at 7, by 7:00 a.m., it already hit, right? And by 7:05, 7:30, it was already on its way down. It was coming down, right? Now, the easiest thing, I could have said, oh, God, it's already coming down. Let me join in, right? Let me join in on this drop, and then so that we make money together. No. When a trade has left you, it's left you behind. That's it, right? I'm not going to get FOMO, right? Fear of missing out. That's a syndrome. It's a disease, right? it's a disease. I will let Lady Jenny over here on our trading. She's a pharmacist. Oh, actually, I have a couple of pharmacists here. Lady Jenny is a pharmacist, and then Sarah is also a pharmacist. I will let Lady Jenny and Sarah, prescribe, some medicines for us. if you will ever find yourself in FOMO, right? I will ask Lady Jenny to prescribe something, right? Lady Jenny is a pharmacist in Charlotte, North Carolina, right? um, it can happen so easy. I could have just joined in when I came back and it already hit. I'm like, God, I should have taken this trade before leaving, right? Before getting out, right? Before getting out. But there's a disease. It's a disease called FOMO. And I know that disease, right? Fear of missing out. I'm like, no, I'm not going to get that disease today. I'm not letting this disease, I'm not catching this, this disease today, right? Fear, fear of missing out. Fear that, this is money, guys. This is money. I'm not going to leave it on the table. I'm not leaving this money on the table, right? I'm not doing that. So I stick with my plan. I'm like, no, it's gone. But I know Monday will be here. I know today's Friday, but Monday will be here. Tuesday is going to be here. Wednesday is going to be here soon. There's going to be a lot of trade opportunities out there. So I do not have to chase it, right? I don't have to chase the market. So jumping into the trades after what? A big move out of fear of what? Missing out. FOMO, fear of missing out. So you see, often results in entering at the top or at the bottom of a move with poor risk reward, right? So you jump in somewhere in the middle and the price has left you, and then you're like, I'm just going to jump in anyhow. No, you're not going to do that. But this is a good move. It's going to keep going up. No, we are not doing that. But this is a huge drop. Can't you see, an explosive drop, in there? This is going to drop all the way down. Why can't we get in? No. So chasing the market, we're not going to chase the market, guys. We're not going to chase the market. I'm starting you guys off with this on the right track. We're not going to chase the market, guys. We are not, right? We will wait for proper setup or pullbacks. Patience always what pays. Patience what always pays. We will do our setup, wait for the right time, and then we'll enter a trade, right? We will enter the right trade at the right time. We will not let FOMO, catch us. We will not get into FOMO, right? And then number 6, buying high and selling low, right? This is one big novice mistake, right? You have an uncle, a brother, a sister, an auntie, at the dining table or maybe at Thanksgiving dinner. Say, hey, have you seen this stock? Have you seen this security? Have you seen this, whatever, it's green. It's going up. It's going up. Don't you want to jump in, right? Don't you want to jump in that stock, right? No. And what happens is that a lot of times, buying, when price is already high, right? When your uncle, your auntie, and other people give you such advice, you say, buy, buy this. The price is going up, going up. You do have no idea where price is on the chart, whether it's already too high. You're going to buy at a place where it's already too high. You can't do that, right? You don't want to be doing that, right? Buy when price already what? Already high after a strong what? Rally, after a strong what? Move up, right? It's already gone up. And what? And selling when price or dropped, and then when they hear the news as well that price of this stock is dropping, dropping, and then they come and sell at a very low price as well. They bought it so high, and then they are selling low. And then guess what? They're on the losing side, right? That means you've lost because you bought it when price already rallied, went up. That is where novice, they will always go and buy that stock, right? When the stock price was 100, they didn't buy it. And then they heard, oh, it's moving, it's moving, it's moving, it's moving, it's moving, it's moving, And then they buy. Can you imagine that, people who had maybe Tesla stocks, moving up, moving up, moving up a couple of days ago, weeks ago, moving up, moving up, moving up. And then they bought it around maybe $300 or something like that. And now the price is around maybe 230 or something like that. Right, and now they out of fear, panic, they might sell it, right? And then they have sold it, they've sold it at a price that they're not supposed to do that because they bought it so high. And now they'll be panicking that, oh, it's going, that's going, and they're losing money, so they'll just sell it and get something small, whatever they can get out. That is what buying high, selling what low. This is the opposite of profitable trading, right? You will end up buying at a demand exhaustion and then selling into a demand, right? Selling into what? A demand where there's a demand. That's the lowest price. There's demand, but you bought it so high and then you can't sell the demand, right? That's not a good thing, right? So we buy near the demand zone when price is lower and support is strong, right? We sell near what? Supply zones when price is higher and resistance is what? Building up there. That's where we sell. We don't buy there. We don't buy at the place of what? Resistance. We don't buy at the place of what? Supply. No, that's not where we buy. That's where we sell, right? And we will learn this, right? We will learn this. So danger ahead, guys. There's a lot of things that, I'm going to conscientize you guys. I'm going to conscientize you guys. Follow the principle over here. Buy low, sell high principle, right? And not the other way around. Don't take any advice from any dinner table from anybody that, oh, did you hear about this stuff? We hear it's going up, it's going up. And then by the time that you are going in, it's already all the way up there, at the what? At the supply level, at its highest what point, at the resistance, right? Where price is likely to drop at that place, right? We don't do that. So 6 novice mistakes, guys. 6 novice. I put together 6 novice mistakes that we are not going to do, right? In our trading journey, we will not do that, right? We will not fall into some of this, pathetic novice mistakes, right? Some of these pathetic novice mistakes, right? We'll not do that. This is very important. This is very, very important that we don't, we don't do that. It's very important. Okay, all right. So risk management, is very, very important, and this is why it matters, right? This is why, it matters. This is why it matters. It matters that we we have a risk management framework, as part of what our trading. So risk management is the foundation of consistent profitability. If you're coming in here and you want to learn this as a lifelong thing, then the goal is for us to be able to take risk management seriously, because that is what is going to make us profitable consistently, right? For the long haul, right? The goal of trading isn't just to win trade just a day and then tomorrow. No, we want to be able to build a very robust, right? System. We want to be very robotic as possible, right? It is to survive and grow over time, right? Even the best strategies can fail without proper risk control, right? Or risk management plan, right? So trading without risk management is like driving without brakes. How many of us want to get in a car, start driving without brakes or seatbelt, in the car? I don't want to get in the car with you if you're doing that, right? And so, trading is the same thing. We do not want to trade without what a proper risk management plan in place, right? No matter how fast or skilled you are, if you're a good driver or not, it will eventually lead to a crash, right? Without brakes in, you know it's like driving without brakes. Get into a car that has no brakes, right? It doesn't matter how fast, how good, how skillful you are, experienced you are. You can tell me all the stories, right? Look, I've been driving since 1990. It's okay. You've been driving for a long, long time, but a car, driving without brakes in the car, we all know the end results, right? Guys, it's the same thing here on this journey, on this training, journey. Our goal here, our first and only goal here is to what? Is to preserve capital. And the way we preserve capital by what? Adhering to what? A very strict, a very tight risk management framework with our trade plan, right? Okay. And so our number one strategy, guys, I'm going to emphasize here, our number one strategy for stopping losses, for stopping us, that's going to stop us from bleeding, right? It's going to be what? Stop loss. Stop loss. A stop loss is a preset level where you choose to exit a trade automatically. You're not going to do this manually. It will take you out what? Automatically, right? It's going to take you out of the trade automatically. If the market moves against you, right? If the market moves against you, stop loss will take you out immediately, right? It's going to take you out immediately. It protects your trading capital from what? Major losses, right? It's going to protect your trading capital from what? A catastrophic one, right? By limiting how much you are willing to risk on any trade. So before we put in a trade, there's going to be a stop loss. When I put in a trade, how much we're going to be willing to, risk. So like the gold trade as an example over here, the gold trade as an example over here, when we are putting in a trade over here, if I'm doing one contract of gold, right? I'm trading this gold, from the futures market. If this is what I'm trading over here, you know, if this is what I'm going to be trading. Oh, I'm on natural gas. If I'm trading this, I need to define. I would define immediately how much what I'm willing to risk, right? And how much I'm willing to risk. That's the USD risk over here, right? It's going to be here. So how much am I willing to risk? I want everybody to type that in the chat. How much am I willing to risk? I want everyone to chat in the chat box over there. My risk is already defined in there, right? $113. I want everyone to put it in there so I know you guys are following, you guys are watching, right? I want everyone to put in there. How much am I willing to risk for this trade? Right? Everyone. I want to see this from everyone. 113. Good. I want everyone because you guys will be getting in very soon on some of these chats. So I want you guys to start, familiarizing yourself with what I'm putting out here, right? So $113, right? This is what my stop loss. This is what my stop loss amount. That if trading, if the price come to me and it come inside, and comes inside, and then eventually it runs through, right? It runs through this my supply zone that I thought it was going to stop it. There's a lot of supply over here, and price. I was thinking that maybe price was going to drop from here, and if there were the orders that are sitting here, the unfilled supply orders that are sitting here, if they could not hold it and then price rallied through this, right? And then keep going, right? Guys, let's say price, keep going. It runs through this all the way, right? Over here, and then keeps going before it turns back. What I'm willing to lose here is what? The $113, right? $113 what I'm willing to lose. So if price rallies through here and it goes against me, I want you to stop me out immediately. I don't want to bleed. I don't want to go 200, 300, 400, 500, and it keeps going up, and then, by the time I realize I'm already down, $800, $900, $1,000, right? So what is my stop loss? My stop loss is that if it gets to 113, take me out. That's it. I'm done. I'm done from this trade, right? I'm done from this trade. But if it goes in my favor, right? If price goes in as it went in over here, right? If price goes in over here, going over here, and then they start returning back over here, and it comes all the way down, right? Comes all the way down, over here, and then I'm out. That is going to be my reward. My reward is going to be what? $1,064, right? $1,064. So at the beginning of every trade, we will make sure that we have what? Our stop loss set in there, right? We will make sure that we have our stop loss set in there. We will not trade and then think that, no, we're not going to put anything in there. We just let it run, or we'll remove our stop loss. We'll put in the trader, right? But we will take the stop loss out. No, we will not take the stop loss out. So some people will put in a trade, just like I've done, and then they will cancel the stop loss, right? Like I've done right now. So stop loss order cancel. So they will cancel it. So when price comes through right now, like this one. So when price comes through, when price, rallies through right now, guess what? The stop loss, that we have over here, because we don't have any stop loss, it's going to run through like this, right? If trade goes against us, right? It's going to run through, and to keep, you're going to be on the negative side, right? But we do not want to do that. We want to be what? Professional traders. We know what we are doing. If price goes against us, if the trade doesn't go our way, right? We want stop loss to take us out, right? We want to be out from the trade. We don't want to lose a lot of money, right? I think this is so cool, right? This is good. This is cool because we do not want to lose money. We don't want to lose money, right? So it protects your trading capital from what? Major losses by limiting how much you are willing to risk on any trade, on any one trade, right? So every trade I'm going to put in, we will make sure, guys. I'm emphasizing here because this is going to be part of everything that we are doing, right? We're going to be doing everything that we're going to be doing. This is going to be a major part of it. Why the use of stop loss? It will prevent emotional decisions, right? When the market moves against you, emotions like fear and hope kick in, right? A stop loss will remove the emotion by automatically automating what? Your exit immediately. So it is not emotion over here. Oh, should I hold on to it? Oh, should I, hold on a little bit and see what's going to happen? No. Stop loss will automate your exit. That's it. It takes you out. You're out, right? You're not going to say, if I hold on to it a little bit, a lot can happen with that emotional decision. Oh, but if I've held on to it, it went in a little bit and then started coming down again. Look, it went in a little bit. Guess what it could have also done? It could have still, go up further, more, right? By the time you realize all your trade capital of $1,000, $2,000 is already gone, right? So we are not going to do that. Once we see a trade, a good setup, we set it up. If we set our stop loss that, hey, price should turn over here. If it doesn't go according to our plan, we want to automate our exit. And what are we going to use? Stop loss. Stop loss is what we're going to use in our trade, right? Stop loss will control losses. No trader wins 100% of the time, right? Now, it's not going to happen. You're not going to win 100% of the time. No trader wins 100% of the time. So a stop loss ensures one loss does not destroy your account, right? You win here, you win there, you win the other day, you win there, and you lose here. Other trade will not go as planned. But stop loss is what's going to make sure that we are still in this business, right? We are not blowing our account. We are not, wiping off our entire account in just one trade, right? So this is very important. This is very important. And stop loss also what enables consistency. Risking the same amount per trade let you survive long enough to profit from your winning trade, right? Enables consistency, guys. Stop loss also what enables consistency. It ensures that we are consistent with our trade. If every trade we're going to risk 1%, 1% consistency, we stay with it, right? If every trade is 2%, 2%, if every trade is 5% of your account, you do it. That's what you do. That's your plan, right? And then the fourth one here is what? It gives you what? Peace of mind. Stop loss gives you what? Peace of mind. You don't have to stare at the screen all day. No. If I had set my trade and left in the morning, if I set my gold trade left in the morning, that's it. It could have given me a peace of mind. By the time I come back, I could have been in the trade. Or I could have been taken out of the trade if it went against me. But if I set it and I have stop loss, it will definitely stop me out. Right? Gives you peace of mind, not to stare at screens all day. You are protected if the trade goes against you, right? When you have stop loss in, you have a peace of mind. You are protected. If the trade goes against you, stop loss is going to what? It's going to automate your exit. It's going to automate your exit. That's it. It's going to automate your exit. You're going to be out of the trade, right? And that's it. Okay. Now, when we are setting every trade, now we are getting to the heart of this, guys. I hope you guys are writing, you guys are taking notes. We get into things right now, right? Every trade must be set. There's an acronym over here, SET, before you enter. Every trade that we will execute, right? Every trade that we'll put in will have what? A set, characteristics, right? We'll have these set characteristics. To trade with confidence, clarity, and consistency, you must make sure that each trade is what? Set, S-E-T, before clicking the buy or sell button. So what do we mean by set? The set means that every trade is going to have what? A stop loss. It's going to have our entry. It's going to have our target, right? Set means what? It's an acronym. We will have what? Our stop loss in there. We're also going to have our entry. And we're also going to have what? Our target. So let me come back to the chart again. Right? Yes, let's use the gold trade again, right? So if you're going to put in, our, the gold trade that we have here, every trade that we have is going to have what? Our stop loss, our entry, and then what? Our take profit or our profit target, right? So our entry price is going to be there. What we are willing to risk, that is our stop loss, is also going to be there. And then our take profit, right? Take profit is also here, right? So before we take the trade, whenever we are taking a trade, I'm going to help you guys to build this tool, right? Very soon we'll build it. But if I'm going long, right? If I'm going long, I've already built some of my, favorite tools over here. But if I'm going long, right? If I'm going long, this is going to be my entry, right? This is going to be my entry. My entry is going to be this line over here, right? And then my take profit. I'm going to have my entry because this is a short position. It's different. It's not a long position. This is a short position. So I'm going to pick up my short tool over here. This is going to be what? My entry, right? And then this is going to be what? My target. My target is going to be here, right? So I'm going to drag my target anywhere. If your target is, maybe you want maybe 3-1 win, right? You're going to put your target over there. If your target is 1-1, you're going to put it over there as 1-1, right? If your target is maybe 4-1 or 3-1, whatever, you're going to set it just like that, right? But just like you set your target, typically whenever you pick up the tool, whether you're going short, that means you're shorting the market because it's coming down, or you're going long if it's going up, automatically by default, this tool that we use, that is called TradingView, they already set it to 1-1. So when you put it, whenever you put your short position tool in there, it already define your loss as 1 and your profit as 1. But we will adjust, our risks, right? We can adjust our risks a little bit because we know where price is likely to turn, right? We know exactly where price is likely to turn. So maybe, we know that, hey, this is the zone, this is the place that, there's a lot of unfilled supply orders. And so when price comes back over here, price is likely to turn downwards, a drop, right? And we will adjust our profit, our target. So what's my target? I can adjust it anywhere, that I want, right? But typically, as we're starting out, we will always be targeting 3 to 1, right? So we can bring it over here, as a start. If price keeps going away, there's something called trade management. I'm going to teach you guys, very soon. Trade management will begin to increase, our target. If, the trade is going our way, it's called trade management, right? Not just because, 3 to 1. And so when it comes to 3 to 1, you said it. Hey, if your rule, right? I'm not saying this because, if your rule says that your profit is 3 to 1, hey, I know some people, they have a very rigid rule. It doesn't matter if the trade goes their favor or whatever. If their target potential, they always set it. They have a rule to set it to 3 to 1. That's it, 3 to 1. That's it. They always do 3 to 1. They set it and they just leave it, right? But I'll teach you trade management as part of this training. So if it goes your way, there's a way that you will keep, adjusting your profit as the trade keeps going down your way, right? As it keeps going down your way, there's a way that you're going to be adjusting your stop loss. You begin to move your stop loss down here. You will not remove it upwards. You will not take it backwards. But you need to move it so that if price was to come back again, it will stop you out wherever profit that you've got into, right? There's a way to do that. I will show you guys, with time. But every trade that we enter, every trade that we're going to find ourselves in, we will ensure that what we have, an entry, a stop loss, and a target, right? That is the SET acronym, SET. SET. We're going to have our entry, the E stand for entry, the S stand for what? Our stop loss, and then the T stand for what? Target. I want everybody to put it in the chat session, SET, SET. I want everyone to type in there, SET. I want everyone. Come on, guys. I want everyone to put in there, SET. Every trade that we enter, we should have what? An entry, a target, and a stop loss. I want everyone. I want to see from everyone. SET. I want everyone to type SET, set in there, right? We will have a set in there. We'll have a set in there. I want everybody to type it, right? Type it. We'll have a set in there, right? We'll make sure that every trade is set, right? We have a stop loss, we have our entry, we have our target. Before clicking what? The buy or the sell button. Before we click the buy or the sell button. Whether if you are selling, like the gold, I was selling. If I taking the trade, but if you're buying, if you're going low, you're going up, you will still do the same, right? Whether we are buying, whether we are selling, we will make sure that we have what? SET set in there, right? Stop loss, entry, and what? Our target. Okay, all right. Every trade, as we see in the set, right? The stop loss defines, as it was defined in the gold trade, it defines how much we are willing to lose, right? I don't want you to put in a trade and then you go back and then you go and cry, right? You're not going to put a trade and say, oh God, I shouldn't have taken this trade. No, when you're taking the trade, you know yourself, right? This is how much you are willing to lose, right? If the trade goes against you. So by set, the stop loss in there, SET, set, right? That's the maximum amount you are willing to risk on a single trade, right? That is the maximum amount that you are willing to you risk on a single trade. So you're not just setting it, guys. I want us to get this right now. We're not just setting it and then just, setting it because you have to set it. No. You need to recalibrate your mind. You need to put into memory here that I'm doing this because what? This is how much I'm willing to risk as a maximum amount. I'm going to be okay if the trade goes against me. If the gold trade that I took, if one contract $113, if the trade went against me $130, if I lose that money, am I going to be sad all day? Am I not going to eat all day? If it went against me, am I going to be all right still? Yes. If one contract, I'll still be all right, right? Stop loss, help protect your account from what? Large and unexpected losses. You see, a lot of emphasis here, guys. There's a lot of emphasis because this is important, right? Nobody's going to tell me. I'm going to tell you, right? I'm going to tell you right from the beginning. Helps protect your account from unexpected what losses, right? Keeps emotions in check by defining your exit before what the market pressures you. Because hey, when the market opens and the market starts moving, I'm going to tell you guys, there's a lot of pressure, a lot of moving pressure, right? You're like, oh, let me go in, let me do this. There's so many ifs, there's so many, assumptions, so many things, right? But when you have a predefined stop loss, it will what? Like I said, automate your exit, right? Simple, take you out. So technical levels below support or above resistance, whatever, percentage of account, if that's what you're using, 1%, 2%, 0.25%, whatever, you make sure that, if I'm wrong, I accept this small loss and I move on with my life. This is not going to bend the day. This is not going to, the whole day is not going to be marred just by this, right? I'm still going to be okay. So that's the stop loss, right? And then the entry, right? The set, SET entry. Entry is what? Where and when will you enter the trade? Your entry should be based on a rule-based strategy, a technical setup, a chart pattern, a break and retest, confirmation. I'm going to be talking about all these things, I'll teach you guys what we call confirmation entry, right? Confirmation entry, let me bring I'll take time. There's going to be a whole session, for that. But just so just as I'm talking about this, let me bring it up here and then show you guys, right? Because something confirmation entry. Confirmation entry basically means that what? Instead of even setting the trade, right? Instead of going ahead, saying one contract or maybe two contracts over here, even before the price, come to me over here as it did right here, I'm going to say, oh, I'm going to do confirmation entry. What does that mean? That means that I'm going to wait and see the price action over here. I'm going to wait till I see the price coming into the supply zone that I've marked over here. And then when price is about to rally out, then I have enough confirmation, so I will rally out with it before it move out of the zone, right? There's a way to do it. Typically you will wait for the price to go in about 50%. If it goes in 50% and it's about moving out, before it moves out, you already set your trade, just like the same way. And so when price rallies out, it rallies out with you. Isn't that cool? But that's what we call confirmation entry. But everybody, I know people say, but then then why don't we do that then, right? That ensures that you're not going to lose money. Yes, there's about 80% chance you're not going to lose money because you do what? Confirmation entry. You've confirmed that price will come. It has come in all right. And it's now rallying out from the zone. It's going down. And then you are rallying with it just at the very entry point. You rally with it because it entered about 50%, right? In the middle over here, that's how we do confirmation entry. You wait till price coming about 50% of this. Can you guys see what I've just done over here? I'm putting a orange line, a yellow line, or gold line in here. I want to see in the chat box. Yes. Can you guys see that? So about 50%, you wait for price to come in about 50% into the zone. Then what? You have enough confirmation. I want everybody to put in the chat box. Yes. You guys have seen it. Because this is a good technique as well. I'll teach you guys, when it comes to managing trade and doing all of that, right? But, just I'm talking about this, I want to highlight on this. I want to hash on this, right? I want to hash on this right now, right? So confirmation entry is what? You wait till price rally into your supply zone. You know that, oh, this is good. That's coming to the zone that I'm waiting for. And then when it's about rallying out, you're very fast. You enter your trade just like you wanted to do it. But there's a way that we put in that order. It is not going to be a sell limit, right? It's going to be the same two contract, all right? It's going to take two contract. But this time around, instead of you doing the market limit or the sell limit, you're going to do market stop. So that when price is rallying out, when it's coming out, there's a way that we go about this, right? It will take the order and then rally down with you at the same price, right? At the same entry point that you wanted to set it, right? That's what we call confirmation entry. Now, this will work at some point in time, work some time for you, but there are times that, you know, instead of the price coming all the way, the price might get over here to maybe somewhere here, and then it might wick through quick, and then it will return. That means you are, you know, if you're waiting confirmation tree, you know, your price is already leaving you behind, right? There are a lot of things, guys. There are a lot of things that happen in the market. The market can be very crazy, right? You're waiting for something, it will not even get to you, and they'll start rallying back down, right? They didn't come all the way. You might see this wick here, this candlestick wick over here. Let me highlight this one so that you guys will see this wick, this green wick, right? There are days I wish I think I may have an example somewhere that I said that I was waiting for it, right? And the price will come somewhere, the body of the candle will raise somewhere, and then the wick will wick through the zone in seconds, split seconds, boom, and then it will start returning down, right? So if you're going to wait for it to come in, walk through and dance and take it time majestically, and then when 50% it is coming out, you know, now you do your confirmation entry and then rally backs down. Hey, that can be a good strategy. You know, if that's all that you want to trade, you can trade that all you want, right? But you're going to be missing a lot of trade, you know, if you're not going to take the entry line type of trade, right? You know, you're going to be missing a lot. But hey, that is another way of taking a trade, right? We will get to that. We'll go through all these market orders, sell limit, etc. Well, when we get to that point, I'll teach you all, you guys, all these different types of orders that are out there, right? You know, I'll teach you guys all the type of orders, right? But now we're just talking about this, right? We're talking about this. That entry, you must set an entry point. You know, avoid chasing the market. Set an alert, right? I have so many alerts on my phone. Set an alert. If you know that price is going to come to, you know, a place of demand, supply, whatever, you know, set an alert that, hey, if the price get closer to this place, let me know so that I'll put in a trade. And there's a way to set an alert, right? I'll teach you guys how to set an alert. And you set an alert at that price that, hey, if price is getting closer to this side, give me an alert over here so that it will give me some ample time to get into TradeView or whatever broker that you're going to be using, and then let me set my trade, you know, and wait for the price to come and get me. And then we'll all right, you know, we'll run with it, right? So guys, you need to have your entry point as well, right? You need to have your entry point. A good entry point improves your risk to reward ratio. When you set a good entry point, that is what, you know, gives you a very good risk reward ratio. Your risk is defined, your profit is also defined, right? You know, examples of breakout of a level, pull back into demand supply zone, candlestick confirmation, bullish engulfing. There's so many things out there, right? You know, I don't just enter randomly, right? You know, when you have an entry defined, entry trade, whatever, you don't just get into trade randomly, anyhow, right? You know, you wait for the right moment and then you get into a trade, right? And then the T, right? The SET, the target, right? You must have a target, the reward defined. You need to define your reward. Do you want 1-to-1? Do you want 2-to-1? Do you want 3-to-1? Do you want 4-to-1? Do you want 5-to-1? Do you want 8-to-1? Do you want 10-to-1? You need to define your reward, you know, ahead of time. That, hey, you know, if I put in $100, I'm raising $100, I need to make 300, right? If you want 5-to-1, you put in $100, you want to make what, 500? That's your risk, right? And guys, when I say risk of 100, it does not mean that your 100 is spent. It's just a risk that if the trade goes against you, that is what much you pay. But if the trade goes, you know, in your favor, you don't even pay, or that risk that you are putting in as $100, it is still your money, right? It goes in your favor, right? So always aim for what? A positive reward to risk ratio. Ideally 2-to-1, 3-to-1 or higher, right? Targets can be set using support, resistance, Fibonacci. I'll teach you guys all these things, you know, where likely, you know, prices will likely turn again if the trade is going in your favor or in your advantage, you know, where in the line you should be able to have eyes to see that if profit gets here, more than likely it's going to hit something over here and it might start coming back again. So let me take my profit here, right? You guys, I'll train you guys to have the eyes to see where price will likely return back, right? Where price is likely to return back. So if you're risking 50 pips to get 100 pips, right? 2 to 1. If you're risking $100, target maybe $200 as your profit, right? So you need to have that kind of mindset that I only take trades that will justify the risk with a strong potential reward. If you're taking trade and the target or the reward is not explicit, it's not clear enough, don't take it, right? If you're taking a trade and the reward is not clear, where then you better not take it, right? You should not take it at all, right? You should not take it at all. So if you're taking a trade, you need to have your target in place, your set, that's your stop loss, your entry point, and your target, right? Your target all defined, right? Your target all defined. So, guys, the reason why I'm dwelling on this set is that, I want us to be able to do things, we'll do things the right way. This class, we will do things the right way. Yeah, I want to see all you guys. I want to see you guys, being, successful. You guys be successful with your trade, right? Or your trading journey, successful. So the stop loss, it is there for a purpose, right? Don't ignore it. Don't take it off. Don't remove it. Don't cancel it, right? The stop loss is there to protect what? Your capital, right? Without it, you risk blowing your what? Your account, right? Without a stop loss, you will risk blowing your account. The entry as well ensures precision and discipline, right? That this is my entry. This is where I want to enter into this trade. Whether it is buying long, going long, or shorting the market, whatever you're doing, you need to define your entry, right? Because we don't want to what? Chase price and lose control. You're all over the place. You are here, you are there, no. You got to be able to define your entry that price will likely come over here, right? And when we are done with this trading, your eyes is trained very well. You'll be able to tell. All of you will be able to tell. All of you, you'll be able to tell that, I see a good, liquidity here. I see a good volume over here. There's a good supply here. There's a good demand here, right? Your eyes will be trained enough, right? That is the purpose of trading. Your eyes will be trained enough to know where price is likely to turn, where there are unfilled orders, right? When institutions make a move, right? We are retail traders. Yesterday I said it. All of us, whether you're trading 1,000, 10,000, 50,000, 100,000, 200,000, whatever, we are all in a category of what? Retail traders. The big institutions, the big banks, when they are in the market, it's millions of dollars. It's several hundreds of millions of dollars, right? That's what they trade with, right? Big move. So when they make a move, we see it. And when they move, they leave people behind. They leave a lot of footprints and unfilled orders behind. And so we know that this is where when price come back to this zone again, this is where the unfilled orders will be filled, to be able to what? Rally down, right? Unfilled orders is going to be there. They are sitting there waiting, right? So this is why, we are learning this. This is why we are learning this. So we enter the trade, we know very well where, there are unfilled orders. There are unfilled orders. They are sitting down waiting, whether in the supply or demand, there are unfilled orders in there, waiting for, price to come to us, right? And then target. Target what? That's what provides clarity and goal, right? You exit too early or too late, right? If you don't have a target in mind, right? When Trump was speaking, as he was speaking, the market was, misbehaving, was all over the place, right? You gotta have a target in mind that, hey, this price is never ending. It's going to keep bleeding, going all red, all the way down. So where are you going to take profit, right? You need to have your take profit, defined. Maybe your TP1, TP2, TP3. Take profit 1. This is where you take the first profit. Take profit 2, where you move it up, manage and then take profit 3, right? You got to define it. If you are not set as a SET, you are not ready to trade. That's what I put out down here. If you are not set, then you are not ready to trade. If you don't have your stop loss, your entry, and your target defined, then don't trade, my friend. Don't trade, right? So good. All right, moving on. When we're done with this, we'll take a quick 5 minutes break and then we'll come back. All right, so there are 6 trading outcomes, right? There are 6 trading outcomes. After this, we take a quick 5 minutes break and then we'll come back. There are 6 trading outcome. I define it this way. I did it myself, put it this way. There are 6 trading outcomes. In every trade that you take, right, it is likely to fall into one of these outcomes, right? Every trade you take, some might say that 5 or 4, but I said that no. There are about 6 trading outcomes, right? Every trade that you take, there are 6 possible outcomes. Master traders understand this and design their strategy to maximize their gains while what? Minimizing risks. Especially avoiding the one outcome that destroy their trading account forever and they might not even come into trading again, right? They know this, that if you're not careful, you might destroy account and you might not even come into trading again. You might not even get into trade again. So what are the 6 trading outcome? As you guys can see, number 1 is what? Large profit, right? Large profit over here. Large profit. That means what? You have excellent results. Let the winners run. And you are in the profit. You're managing your trade, and it keeps winning. It keeps going in your favor, right? So just let it run, and you're managing it, right? Large profit. And then we have small profit, right? Small profit is typically when maybe a typical maybe 2 to 1, 3 to 1 hit, right? Your take profit 1, take profit 2, maybe 3 to 1 ratio, risk reward. It hit. So you hit your TP2 or 3 or take profit 3 level. That's a small profit. And then there's an outcome as well. Break even. Break even means that there is no loss, there is no gain. Where you entered is where you have exited, right? You don't know where the market is doing. The market is not moving, and so you want to be out. You want to be out because you are not sure. Where the market is. If you are watching it, if you are sitting down in person and you're watching the trade in real time, right? Break even. Break even means what? No loss, no gain. So that means what? You move your stop loss to your entry, right? You move your stop loss to your entry so that hey, take me out if you are coming down here. I don't want to trade again. Break even, right? I'll teach you guys. We'll do all these examples, on the chat. We'll have a lot of examples on the chat, and we will learn how to, do this. Break even, and then we have small loss, right? Small loss means what? This is a planned loss. That is what we are using stop loss for, right? This is what? A planned loss. When you have a small loss, means what? This is a planned loss that's controlled. This kind of loss is controlled. When we hit our stop loss, that is a planned loss. We knew ahead if the trade was to go our favor, hey, that's good news. But if the trade was going against us, we only wanted to raise 50 euros, $50, $100, $200, $500, $1,000, $10,000, right? So it's a planned loss. That if I lose 10,000, yeah, I'll still be okay, right? That's your loss. That's your plan, right? If I lose $100, it's your plan. If I lose $50, $20, $10, whatever, that is your plan, right? Small loss. Small loss. You plan for it. If the trade goes against you, this is how much I'm willing to risk, right? I'm willing to lose, right? So you're okay with it. A small loss. And then we have large loss. Right? This can be very dangerous, right? This is where you remove your stop loss, right? There are no stop loss. You have ignored the stop loss completely. Guys, this is going to happen. This is why I'm telling you guys right now, so that you don't come and tell me stories that I remove my stop loss. No, why do you remove it? You're not supposed to remove it. Don't touch it. Leave it. Right? If it goes in your favor, good. If it goes against you, stop me out. I don't want to lose more than this amount or X or Y amount, right? So that's your stop loss, right? And then we have catastrophic loss, right? I was watching a video of these guys, and some of their big loss. This is very huge. $160,000. One guy was like $22,000 in a trade, right? Because he went in all very big. He thought the trade was going to go in his favor, and then he's going to win massive money, right? And You know, as a price, you know, and you didn't have any stop loss, definitely. As you guys can see, when we talk about a catastrophic loss, that means there's no stop loss here, right? No stop loss. It kept going down. It kept going down. Kept going down. He said, "No, it will bounce back. It will bounce back. It will bounce back. 10,000. It will bounce back. 20,000. It will bounce back. 30,000. Oh, price will turn again in my favor. 40,000 to come back. 50,000. Keep going. Keep going. Let me stay in a little bit. I'm already down 50,000. So what is it? Let me stay in small. 60,000, 70,000. At some point in time, he he knew that, you know, nah, this is not going to go well, and then he needs to what, you know, cancel the trade altogether. By that time, you're already close to $100,000, right? Hey, I do not want this to be our story, right? I don't want this to be a story where we're in a trade and then, you know, we put a stop loss and keep going, keep going, keep going, and we say it will bounce back, it will bounce back, it will bounce back. No, no, you know, we're not going to do that, right? We're not going to stay in the trade and say that it will come back, it will come back, it will come back, right? It will come back. But all these large profit, small profit, they have definitions. So let's get some of the definitions, you know, quick here. So large profit, you know, means that this okay when the trade moves strongly in your favor and you manage it correctly, right? You know, hey, if you get a big win, I want you to manage it very well. If you're in a trade and the trade is going in your favor, guys, you need to manage it very well. I want you to manage it very well and keep the profit. Keep, you know, bagging on the profit. You know, in my local parlance, you know, I'm from Ghana, right? So you say, and tendency, and here, you know, also manage your trade, you know. Like I say, manage your profit, right? Don't waste any profit, right? Don't waste it. So, you know, you keep managing it, keep managing it, right? So that's a kind of live profit. This one, you know, it already hit your profit, take profit one, TP1, TP2, TP3, 3 to 1. It's already going to the moon, right? Manage it small. Be moving your stop loss after your profit, so that in case it retract, then it stop you out at whatever profit that you've made, right? That's it. That's the kind of large profit we're talking about here, right? In a 6 trading outcome, large profit we're talking about here, right? And sometimes it can happen, and this happens all the time, right? This happens all the time. You know, you can easily get 8 to 1 trade, you know, 10 to 1 reward, right? Easy. It happens all the time, every day, right? So you need to be managing it, right? So you risk 100 and then end up making 500 or more. You know, let your strong trades, you know, breathe and compound your edge, right? So be managing it. I'll teach you guys how to do that. And a small profit is what I mentioned. You know, it's almost like maybe 2 to 1, 3 to 1 type of profit, right? And then break even. We say break even. That means your entry point is also what your stop out, or right, or your stop loss, right? You know, your entry point is the same. This happens when your trade initially moves in your favor, but you know, you move with your stop loss to your, you know, your entry point and get stopped out, right? Sometimes when you're in a trade and you know the trade is in your advantage, and then when you're in a trade and you know, it moves out and you're making profit, and then you move your stop loss, you know, to your break-even point, and this happens all the time, right? You know, you move your stop to your break-even point, to your break-even line, or to your entry line, right? To your entry line. And then all of a sudden, the price maybe retract quickly and then stop you out of the trade, right? This is going to happen a lot. I'll show you guys, and you guys will see this as well in real life, you know. So what happens is that it's break-even. Your profit and your loss are all the same. That means there is no loss, there are no gains as well, right? No loss, no gain, you know, but it's a smart defensive play, right? As soon as price start moving up, you move your stop loss to your entry, so that hey, even if I'm stop out, or even if by whatever that happens, price action and something happen crazy, and then the market start falling again, you will immediately be stopped out at where you entered, right? That's break even, right? Right? That's break even. So you enter at 100, move your stop loss to 100. At the price hit 103, when the price started moving up 103, and get stopped out, and then it comes back again. You know, so that can be like a lightning speed, right? You know, and then you know you break even. Your profit and loss are all the same at your entry, right? So that is break even point. Break even point. All right. And then the small loss, I talk about small loss as well. This is common and acceptable loss in trading because what you plan for it, right? Is a trade where you get stopped out, but it was what planned risks. You already knew when you put in the trade, you've already planned ahead and say, hey, my stop loss or the amount I'm willing to risk is $100, $200, right? $300, 500 CVs, 800, naira, right? 1,000 rupees, right? Wherever you're watching me from, right? So you already putting, your plan risks. So you already know ahead. You want to lose 1% or 2% of your capital, right? And move on to the next opportunity. That's it. So racing 100, your stop loss hit, and you lose 100. That's it, right? You go to the next one, the next opportunity, because you already planned for this risk, right? You already planned ahead for this risk. You knew if something was to go against you, that's it. Should stop you out at 100, at 100 cities or whatever. You already there. You already planned for it, and so when it hit, that's it. It takes you out, and you're out of the trade. Losses are part of trading. As long as they are small, you can always recover, right? You already planned for it. Right? You've already made some profit in the market, and so raising $100, raising $50, raising 10 cities, raising 50 naira, raising shilling, whatever amount, rupees, whatever, it is there. So small loss is what you plan. And then large loss. Large loss is when you don't use a stop loss, right? You don't use a stop loss, and then it happens. You let the emotions take over you, fear, denial, hope, and things like that take over you, and then that's it. You are exposed to unlimited downside, right? This can be catastrophic, right? And then we have what? The big one, the huge loss. This one is like a hole. I was looking for a picture. I said, let me get a picture that I can get a deep hole, somewhere, right? Deep hole somewhere, then put that in there. Once you are out in like a hole, you are inside a hole like that, guys, it's going to be very tough, to dig your own self up again, right? It's going to be very tough for you to be able to bring your own self up because it's a big hole, it's a manhole. You're already deep down, right? You were holding on to hope. The price was going to bounce 10,000 and you're still holding on. 20,000, you are still holding on. 30,000, you are still sinking. 40,000, by the time you know 50,000, 100,000, 20, 200,000 is gone, that's it. That's it. There is no point of return, right? It's going to take a miracle for you to be able to bounce back, for you to be able to recover your loss, right? Once again, right? It will take a miracle. It will take some type of divine intervention, right? For you to come back. All right, guys, I'm going to give you guys 5 minutes, right? 5 minutes for our break, and then we'll come back soon. All right, 5 minutes, guys. Okay, all right. So now that we are done with the 6 trading outcomes, let's now look at fundamental analysis, right? What's it's very good for us to know about this but we will not trade, essentially, we're not going to trade based upon this, breaking news and what the papers are saying and what is saying on CNBC. You know, we are only trading by what we see on the chart. That's what we trade with. We don't chat with people's opinion, right? So fundamental analysis is the process of evaluating financial assets like stock, currency, and commodity by examining related economic, financial, and other qualitative and quantitative factors, right? The goal is to determine the intrinsic value of the asset, which helps investors decide whether it is undervalued or overvalued, right? So, when we say fundamental analysis, you know, we're talking about, getting a very good pulse of whatever stock, whatever asset security that we're trading, sometimes, through some economic news, sometimes through maybe the companies in themselves, maybe their balance sheet, some things like that, their earnings reports and, things like that. These things are all good, right? The board members, who are the board members that are running this company? Where did they come from before coming to become board members? Who is a CEO, right? Who is a CEO? Who is the CEO of the company? Who is, leading this, and, who is um, um, running the show at the company. All of this gives some credence, right, to the company. Because if I know that, oh, this person is the one running this company, and I know this company is going to go the right way, right? Because he's a very good manager, very good CEO, right? All these things are very good. It helps us to determine an intrinsic value of an asset, make sure that, oh, this is a very good company then, if all this is happening, their profitability, etc., it's all good. Yeah, sometimes, we look at all these things and it's good. It gives us a projection of their future outlook, right? The future outlook of the business, and we tells us something about it, right? But we don't necessarily trade it. So things like, when we're talking about fundamental analysis, we're talking about, economic indicators. When you hear GDP growth, oh, there's a growth of maybe 3%, whatever, it's good. Unemployment rate, these are all good, fundamental analysis, key elements, right? Unemployment rate is going down, right? Inflation, right? Inflation is coming down, inflation is going up. All these are good, right? All these indicators are good, right? Economic indicators, interest rate, right? Jerome Powell, that's the name of, the Fed chairman over here in the US. Every now and then they come and read all these things and tells us what the direction is, whether it's increasing inflation rate or interest rate, or it's coming down, it's going up, whatever, right? And the market reacts seriously, right? All these are good, but we don't really care. We only care what we see, right? Industry health, trends, stability within the sector of the asset, right? Yesterday, we took some time to talk about all these sectors, right? The sectors that we will likely, will be trading, right? You know, Industry health, we take a look at that. Company financials, right? So their revenues, earnings per share, profit margin, return on equity, debt level, cash flows, etc. All this data is good. There's nothing wrong with it, but we call all this type of information fundamental analysis, right? When you're trading, it's good that we know what is going on with this company. That's fundamental analysis, especially if you've bought stock, right? If you bought stock and you are hoping, and hope is not a strategy, right? You're hoping that someday, 3 years time, 5 years time, maybe the stock value will appreciate, and then you make money, right? It's good. News event, political changes, when a new president, is inaugurated, right, comes to power, right? Political changes can change a lot of things, right, in the market, right? Like the one that we are experiencing right now, right? It's turbulence, right? But we love it. If you're a trader and you don't love what's going on, I don't know what's wrong with you, right? Because you want the market to be volatile. So what is moving up and down, you're making money, right? When Trump speaks, there's money. right? So political changes, it's something that you have to be aware of, right? And all this part of fundamental analysis, right? Central bank decisions, right? Geopolitical tension. Trump says I'm going to it's going to be tariff of 20%, 30%, 10%, 35%, 25% on this country, on that. Geopolitics tension. That's what geopolitics. China says I'm going to retaliate, right? Geopolitics. That's geopolitics going on. This is going to impact on the market, right? But again, we don't really care about this, right? We don't really care about this much. Like, hey, what is China saying? How am I going to trade tomorrow? Nah, you're not going to do that, right? You're not going to say, Nana, I saw something in the news. China said they're also going to they're also going to put a tariff of 35% on America. Look, we don't trade based on what China is saying, right? But they are fundamental analysis. There are key things that you got to be aware of what's going on. But hey, you know, natural disasters, right? Or pandemics, right? These are all what news event, global development. We got to be aware of. They're all part of what fundamental analysis. Now, why we learn fundamental analysis, but we don't necessarily trade it, right? It is useful for context, but not precision. We are not trading based off on this, right? That hey, the breaking news. Did you see the breaking news? Did you see what they said on this talk on CNBC? Can we trade it? No, right? It is useful for context, overall context, right? But it is not precision. It is not, they're not telling you to go and buy this, right? Fundamental analysis give us a directional bias, right? This is where the market is likely to go, right? It gives us a directional bias. The market is ready to might rally up, might go up, or it might come down, right? It gives us directional bias, right? Very important. Market sentiment, but not exact trade entries and exit, right? If they are telling us this, it is not telling us where to go and put your trade and where to exit, right? Where to have your stop loss, right? Or where to have your profit target, right? For example, knowing that inflation is rising may suggest long positions in certain commodities, right? But it doesn't tell you when to enter a trade, right? No, it doesn't tell you that, right? Price always leads news. By the time economic data or earnings are released, market have often, already maybe priced in the information, right? Pricing information, pricing information. That means traders who rely, right? Traders who rely on fundamental analysis might be too late. It might be too late for them, right? It might be too late for them. Take a look. Right? It might be too late for them. Guys, let me show you something. I was going right now. It's already 6 o'clock. Hey, take a look. It's already 6 o'clock and the market just opened and then the market is going wild already. Let me show you guys. When Sunday night comes, it is 6 o'clock. Let me show you guys right now. Can you guys see my screen right now? Can I just say a yes in the chat? Can I see a yes in the chat right now? So the market just opened, right? The futures market just opened. It's already 6 o'clock. The market opened Sunday night at 6 for the futures market. When it opened, look at what it did right now. Gold. This chart that I had on just opened, and phew, the price just came all the way down here, right? 3,006, and now it is what we're tracing back. It's way back to 3046, right? So if you were in a trade over the weekend or something, you put in something, and maybe you were shorting it. If you were shorting it and you had a target in there, then maybe you could have made money. But we don't trade, with that. When the market opens like that, there's a lot of movement going on. But we just have to sit down and then wait and see, what is happening, right? It's a Sunday evening, guys. The volume is not going to be there, but I can see volume is spiking up right now. For sale, people are beginning to sell. Right now, right? I can see that price is coming down. It's already moving. But the market just opened. Right, the futures market just opened, and it's not just this one. Most of the futures product, they are all open right now. Crude oil. Well, look, there's a gap. As a matter of fact, when it opened, look, it's already spike up like this, right? This is huge, right? This is huge on the 30 minutes time frame. Look, it's still coming down. So that means the market is open, it's active right now. You know, oh my God, look at the Russell. The Russell is all the way, right? Let me see the Dow. The Dow is also open up with a gap like that. It's coming all the way down. Oh my God, what is happening? That's the same thing for the Nasdaq. And the Nasdaq also there's a huge gap, from where it opened, where the price, closed on Friday, and where it opened right here, and it's rallying down. So, I know people are going to jump in. People will jump in right now and take, take a trade, right? If you take a trade right now, I can take a trade right now on like a paper trade. If it goes in my favor, then it's good. If it doesn't go in my favor, it's not good. But it is just an example, right? Just an example of what is happening right now on the market, right? It's just an example of what is happening right now. Like, people are, shorting the market already, right? If I go onto the 1 minute chart, if I go to the 1 minute chart, it's giving me a very good picture of what is happening. So it came all the way down. The market came all the way down like this, and then I can see that now people are beginning to buy again, right? So if I wanted to buy something, just an example, this one is not a good position I'm taking. If I wanted to buy something right now, I can go ahead and then create a buy stop, right? Oh, it's already run through my entry. Hold on, let me see if I can get a quick entry over there. See maybe five or something. Oh, I couldn't get in, and price already come to the level that I wanted to enter. So the level I wanted to enter is maybe this one. Let me do a quick one and see if it will. I can get in on this trade right now. And this, I'm not using any live money. This is just a paper trade, right? We might be wrong, we might be right. It's just give you an example that that's how the market moves. All right. Even now, I wanted to go long, but it's coming down. Right? It's even coming down right now. I can see a big red candle, coming down. But guys, it's just an example of how the market, when it moves like this, there's a lot of action. 6 o'clock is Sunday night, you know price is already beginning to move a lot over here. All right, let's run to our slide. As for the market, we'll have time to deal with the market. We're going to have time, right? People are already making money, right? People are already making money. All the candles that you see over there, it's money, right? It's money. People are making money. All right. So, it might be too late. Pricing the information, that means traders so rely on fundamental analysis might be too late, right? If you're relying on just somebody telling the news, it's already too late, right? Market reacts emotionally to news, right? Sometimes good news result in price drops, and bad news result in price rallies, right? Because traders often buy the rumor and sell the news, right? Market psychology can override economic, logic in the long term, right? This is very important. And fundamental are always for a long term, right? If you go to trade fundamental stuff, then you should be targeting long term, right? It is not always black and white, guys. Fundamental analysis, sometimes, every information that they throw out there might be looking good, but it is not always black and white like that, right? Interpreting economic data is often subjective, right? One trader might see rising interest rate as bullish for currency, whilst others sees it as bearish due to a slowing growth, right? So different picture, different people, different things are being seen out there. All right, let me get into this so that I want to end with this, right? I want to really end and with this thing before we finish up today and then give you guys your assignment. So what moves the market? I already talked about it that the market is an interaction of what buyers and sellers, right? Buyers and sellers on the market, represented by what? Candlesticks, right? Represented by candlesticks. When you see candles over there, that means there are buyers and there are sellers over there. And these are the people that are moving the market, right? Whether they are buying, whether they are selling, whatever you see over there, that is exactly what it is, what it is telling you, right? Candles is what it's showing us. It's telling us exactly what is happening. So if you see a green, that means there's a lot of buyers in there. If you see a red, there's a lot of what sellers in there, right? That's what the picture is telling us, right? Now, when orders are placed in, I want to give you guys an order flow, right? Whether for sell or for buy, whether for demand or for supply. I want to give you guys an order flow, right now, right? Order flow is the flow of buy and sell orders in the market. When we look at the market, how do we buy? How do we sell? How does our orders get in? How do they get executed? Right? So it is driven. Order flow is generally driven by some of the things that I just mentioned in fundamental analysis. But sometimes to perceive, value, there's fear, there's greed, uncertainty, market expectations, different things, right? Bullish news, earnings beat, negative news, all the things that I talk about. Your brother, your sister, fear of loss, profit take. There are different things that essentially is driving the order flow out there. But typically, when you put in an order, this is how it starts, and this is the kind of process it goes through, right? This is the process it goes through. So, retail trader like yourself, myself, you guys, you the trader decide to buy. If you buy something, like if I was buying gold, maybe 10 or 100 shares, right? 100 units, whatever, of SYZ share at 50. You send that order through your trading platform. So whatever platform that you're using, that's where you're going to send the order through, right? When you send the order to that platform, that's number one. Number two, order is sent to the broker. The broker is like a middle person, who you trading with or who has your money, right? I'll teach you guys all of that. You guys will set up a brokerage account, etc. Right? Very soon. But the order is sent to the broker. Your broker receives the order and route it to an exchange, right? Whether to the NYC, the New York Stock Exchange, or the NASDAQ, or the Dow, or any other market, right? Maybe the London Stock Exchange, whatever, right? So they receive your order, that's your broker, and then they route your order to the exchange, right? Now, number three, the order hits the exchange, right? Once the exchange, receive your order, a couple of things is going to happen. Once the exchange receive your order, a couple of things is going to happen. So one, executed immediately. That means when they see the order, they can execute it immediately, right? That means it's a market order. That means that order that is coming in, you want to buy at the price of whatever that commodity or asset, whatever you are trading, whatever you want to buy, you want to buy at the market price, right? So that means immediately. Or it can be a limit order, right? So when it's a limit order, that means that maybe price will likely come to this zone, right? So I will buy it here. So that means it's what? It's a limit order. You're waiting for the seller at your desired price. So if I know that gold is going to come to this point, it's going to come to this price, X or Y, amount. I'll say I'm placing an order and I'm waiting for gold to come to this price. And when it comes to the price, that is where I will buy, right? So placing an order book, right? That's what we call a limit order. You're waiting for the price to come to the right price, and then what? You will buy at that price, right? And then the third or the fourth point here is the order execution. Let's say all these conditions are met, right? Maybe you are buying at the market price or you're doing a limit order. Let's say some of the conditions are met, right? What's going to happen? There's going to be order execution. Your buy order is matched with someone's sell order. So somebody wants to sell on the market, that's what happens. It's buying and selling. Somebody's selling, somebody's buying. So let's say that your buy order matches with somebody's sell order, a trade occurs. That's what happens, right? Trade occurs. Trade occurs. And then guess what? When trade occurs, you are in a trade now, right? You are in a trade. When trade occurs, that means you are in, right? You are in. This action is recorded on the chart as a candlestick, a stick, right? So when trade occurs, when your buy order and the sell order meet, right? Somebody want to sell, somebody want to buy. You buy it, you sell. When that becomes a trade, guess what happens, right? Then a candlestick forms on the chart. So the candlestick that you guys are seeing on the chart, when the candlesticks form, that means what? That means there is what? An order has been executed, right? That is why there is what? A candlestick representation of the buy order or the sell order, right? If you see a red, that means there's a sell order executed. If you see a green candle, that means what? There is what? A buy order as well, right? That's how it works, guys. So green candlesticks means, as you see it over there on the chart, that means more buyers, demand, price is rising up. We're going long, we're going up, right? And then red candle, as you see on the chart, means what? There are more sellers, right? There's a supply. Price is falling. It's coming down, right? We're selling or we're shorting the market as we say it, right? So this is the order execution flow, right? This is the order execution flow. This is the order execution flow. So as a retail trader, you send your order. Can you guys see my screen? I want to see a yes, yes, yes in the chat. Can you guys see my screen? Yes, yes, yes. Can you guys see it? Okay, all right. Is it Chief Oli that is seeing my screen? I want everybody see my screen. Okay, all right. I want you guys to see the flow. All right. So the retail trader, you send in your trade order and it goes to the broker. The broker sends it to the exchange, right? And then if it's a limit order, market order, or all the other types, there are so many other types of order types, right? Whatever like this, now we will see it on the chart, right? We will see this on the chart. That's buy orders or sell orders. It will be represented by what? Candlesticks. It's going to be represented by what? Candlesticks on the chart. On the chart, right? It's going to be represented by candlesticks on the chart. All right. So the order flow is very simple, right? The order flow is very simple. Orders that are sent, that means order has been placed via a platform and is on its way to the exchange, right? That is number one. Executed, when the order matches and then is completed, it is what? Executed. When the order gets sent, that means you've sent something out, and it has been placed on the platform on the way to the exchange, right? Now, when the order is executed, that means order is matched and completed. That's what it is, right? It's completed. And then when the order is filled, that means same as executed. This is what shows up as candles on the chart. When the order is executed, then the order is filled, right? You will begin to see, candlesticks that are formed over there on the chart, right? That means the order is what? Is what? Executed and filled. And there are also unfilled orders as well, right? Unfilled orders. Sometimes when we see a big strong moves, right, on the chart, explosive move, right? Whether red or green, sell or buy, whatever it might be, that means there are in our mind, we need to be trained. We'll be going deep dive on this. This is where we will measure in, right? This is like the heart of our training. I will train you guys, your eyes, to be able to see where there are unfilled orders, where price is likely to come back and then, grab all the unfilled orders and then move with them, right? Unfilled orders is like, our meat and potato, where we're going to see things, right? That's how we make money, right? We need to be able to spot unfilled orders on the chart and be able to, recognize it and say, price is likely to come here. And then when it comes here, we will trade with it, right? We will trade with it. So unfilled orders mean that not much yet. These are pending limit orders, potential what? Turning points on the chart. These are places that price action, if it's likely to come over here, whether rally or drop, when it comes over to this zone, price will likely what? Turn, to the other side, whether move up or move down. It doesn't matter, right? Whether move up or move down. So unfilled orders, this is where we will be looking at. Whenever there are unfilled orders, that means it's an opportunity. There's an opportunity right there waiting, right? Unfilled orders are places that, they are unfilled orders. They are points of what? Opportunity. So we're waiting for price to come there so that, we can get in on that, right? We can get in on that. So this is very important. Candlesticks, candlesticks shows the results of order flows, right? Candlesticks always, anytime you look at the chart, if you're looking at the chart, you're looking at whatever, that should tell you that, this is, the result of order flow, right? Every candlestick that you see tells a story. As I show you guys right now, that the market has opened and then the price, it has gapped down, red. That means what? That means it is telling us a story. What is happening? That means there are aggressive sellers. People are selling, right? There are aggressive sellers on the market right now. They are busy selling, right? The way that they move, very explosive. I saw one of the chart, very long red candle, right? Different things. That means aggressive sellers, Aggressive sellers. People are buying, people are selling, they're doing all sort of things, right? It's going to happen. That's how it is. A strong green candle means what? Aggressive buying. And when there's aggressive buying, that means, they are overwhelmed. They're what? The sellers. The buyers, if overwhelm what? The sellers. A long wick on top of a red candle may show sellers absorb all the buying pressure, right? So, possible supply zone, right? A strong red candle in previous support or whatever, followed by a bounce, may indicate demand at that level as well, right? We will get into proper anatomy of the candlesticks, and we begin to understand this properly, right? Begin to understand this. So candlesticks, tell the story, but our main thing is about the unfilled orders, right? Where we want to dwell, where we want to center, where we want to be looking at is unfilled orders. These are potential supply and demand zones, right? Because these are potential supply and demand zone. So we need to be able to identify areas of strong reversal in the past. We will be looking for sharp moves with little resistance and impulse moves, right? Very important. Those areas are, likely had a concentration of unfilled orders. I'll train you guys. We'll go to the chat. We'll see all these things, right? In our training. We will draw zones around them. I'll show you how we will draw zones and draw a supply zone, demand zone, etc. Right? Supply zone, price drop faster after what? Stalling. Demand zone, price rally faster after what? A slowdown. So we're going to wait for price to come back to these zones, right? And then we'll go with it. If price revisits the zone, we'll watch for what? Confirmation, like a wick rejection, engulfing candles, etc. We don't necessarily trade all these candles, but I will teach you guys how to look out for some of these things as well, right? I'll teach you guys how to look out for some of these things in there. But guys, unfilled orders, they're like, the thing that we got to be looking at all the time. We got to be looking at all the time. Unfilled orders. We got to be looking at all the time. All right. What's the time right now? Let me look at the time. Oh, man. Should we continue? Would you guys borrow me maybe some 10 minutes, 15 minutes to go through this? Should we continue? I want to see in the chat box, guys. Should we continue? Will you guys borrow me some 10, 15 minutes to get through the candlesticks, anatomy of the candlesticks? At least you guys will have something for the week, right? I want to push this so that at least you guys have something for the week to look at, right? Is that okay, guys? I want everybody to put in something. Is that okay? I want us to push this so that at least you guys have something, and then your assignment will come, right? Okay, all right. So let's look at the anatomy of the candlesticks, right? Anatomy of the candlesticks. Okay. So, our science students over here will tell us anatomy is a branch of science concerned with the bodily structure of humans, animals, and other living organisms, right? Especially as revealed by what? Dissection and the separation of the parts, right? As you guys can see over here on the right side, I have an image over here, the skeletal system, right? Skeletal system has so many parts, and we have, names, etc. That is not my goal. That's not my focus for tonight. But in the same way as we have the anatomy, we have the anatomy of the body or the bones or any other parts of the body, we have the anatomy of the candlesticks as well. Candlesticks have parts, right? There are parts to what a candlesticks, right? Candlesticks. And we need to learn that. All right, moving on. So what is a candlesticks, guys? We get into the heart of things now. We get into the heart of things right now. A candlestick is a visual representation of price movement over a specific period of time, like 1 minute, 1 hour, 1 day. Let me bring the chart over here, right? So we can all see. We can see this, right? So a candlesticks. Can you guys see my screen? The chat right now. Can you guys see that? Put in a yes right now for me, please. Let me know you guys are tired. You guys are following, and let's move, right? You guys can see it? Okay. All right. So, a candlestick represents what? A movement over a period of time, right? I'll teach you guys. You guys will come here very soon on the chat, right? So, when it comes to the chat, we have 1 minute time frame, We have 5 minutes, 15 minutes. I have set my time frames, you know, what I want, what I'm looking for. Like 1 week, month, day, 4 hour time frame, 2 hour time frame, 1 hour time frame. Every time frame that you select, you know, it represents the formation of a candle. Every candle over here is formed within that time frame. If I say 1 minute time frame, that means this candlestick over here formed within 1 minute, right? It's a visual representative of price action within that minute, right? It's a visual representative of that. No, I did that. Maybe I use it for something. Let me just leave it in there. It's a visual representative of what? Price action within that time frame. If I say 5 minutes, that means this candle also formed within 5 minutes, right? Guys, I want you to take note of it. We're getting into heart of things right now, right? I want you guys to take note of this. If I say 15 minutes, that means this candlestick, each one of these candlesticks over here, they formed within 15 minutes. Doesn't matter how small, how tiny, how big, they look, right? They formed every 15 minutes, right? If I say 30 minutes, right? That means this candlestick was formed in 30 minutes, right? The time frames over here, sort of defined, the movement of this price, the price action over here over time, right? Over a specific period. So when I say 4 hour time frame, that means this whole candlestick that you guys see, it was formed in 4 hours, right? 4 hours. This one, the same thing. This candlestick over here that almost looks like a doji candlestick, over here. It was formed in 4 hours. Every candlestick over here was formed in 4 hours, right? It doesn't matter. Every candlestick that is on this chart was formed in 4 hours. If I say daily, right? If I say daily, same thing, right? That means in the whole day, this was what was formed, right? It could be a bearish, or it could be a bullish, right? It could be a red candle, or it could be a green candle. But daily, that tells us that the whole day, that day it was bearish, right? And then we have weekly, right? If we have weekly candles as well. So that means this whole candle formed in the whole week, from Monday to what? To Friday, right? From Monday to Friday, a whole week, right? We have weekly candle as well, right? So that means what? The candle was formed for the whole entire time of that period, specific period, right? For the whole week. And then we have what? Monthly as well, right? Monthly. I want us to take note of this. We get into heart of things right now, right? We get into our chat, right now. So you guys should be paying attention now. So monthly as well. This candle formed within a month, a whole month, right? This candle formed within a whole month. This one formed within a whole month. This one formed within a whole month. This one is it's also in a month right now, right? As I put the mouse cursor on it, as a matter of fact, I put mouse pointer on it, it's telling me this one was in January. This one was in February. This one was in March. So the whole of March. This is the candlestick that showed. So each one of over here. This is October, right? Last year, October 24. This is what? This is November. This is October. This is what? September. This is what? August. This is what? July. This is June. This is May. This is April. So every candle stick you see over here, because I've selected the time frame to be a month, that means it is price action or price movement over that period of time, right? So if it's bearish, that means the whole month it was bearish, right? There's a lot of selling going on. If it's green over here for the in a monthly time frame, that means we can say that in the month of January, that means it was what? Bullish. It was very bullish. That means that month Nasdaq was bullish. That means there's a lot of maybe bullish buying, right? It represents the whole thing from January 1st to the end of the month, right? It's being represented by this candlestick over here, right? This month, this is when December almost looks like everybody was away in a vacation, right? Not a lot of things going on. So every candlestick over here is a visual representation, guys. I want you guys to pay attention. It's a visual representation of a period of time. Now, each candle shows where price open, where price close, the highest and the lowest point during the time, right? Every candlestick that you see, will show something that, oh, this is where price open, this is where price close, this is where price close, and maybe this is the highest, this is the lowest point. This helps traders. Every candlestick we're going to go through very soon. I'll be showing you, where it open, where it close, where it open, where it close, the highest point, the lowest point. We'll be looking at that momentarily, right, guys? We'll be looking at that. But it tells us a story where it open. If I'm looking at the 30 minutes, candlesticks, it tells me where it opened, where it closed, what was the highest point, what was the lowest price that buyers were selling, buyers were buying, and the sellers were selling. Right? It gives me that information. Right? It gives me that information. Can you guys hear me? Okay? Am I audible, guys? Am I audible? Yes, yes, yes. Go ahead and put a comment on the chat box. Yes, yes. Am I audible? Okay. All right. Good. I thought my hand hit something over here. I want to be sure that I'm still audible, right? So every candlestick over here, there's a lot of things over here. We get into the anatomy, right? The science people are here. The anatomy, the parts of the candle, right? There's a place that it open, there's a place that it close, how the shape look like. We'll get into all these things. There are different types of candlesticks, right? There are when look at the candlestick, don't think that they are all the same. No, they are not all the same, right? They're not all the same. There are different types, right? But we will not going to go through all the different types. I might just share maybe the common, maybe 9, type of candlesticks, very common ones, that happens, they kind of show up, every now and then on the chart, I'll just go through that. But I will give you guys all the resources that you need. There's so many candlesticks out there, right? But this helps traders to see who is in control of the market, right? We'll tell them, oh, I think it's a bull's market, it's a bear's market. Sellers are in, buyers are in. Price movement over a period of time, when you look at it, oh, today it was a bullish market. That means, but there were a lot of buyers, right? Buyers were exhausting. They were overwhelming the sellers, right? Sellers at a point in time went to zero. If it was a bullish market, and buyers were exhausting sellers, that means sellers went to zero and then buyers were going up, right? That's what that means, right? So green candle, whenever you look at a green candle, right, this is what it means. I hope you guys can see my screen. This is what it means. When you see a green candle, that means buyers, that means bulls were stronger, right? Bulls were stronger. And then price close higher than it opened, right? Price close higher than it opened. So typically you will see the structure. We get into the science right now, right? The anatomy, right? See the structure. We have the open, that is the bottom of the body, right? And then we have the close, where price close at the end of the day. That is what the top of the body of the candle, right? The top of the body. And then we have the wick. The wick is the lines that are drawn here. Can you guys see my mouse pointer? The lines that are pointing out from the body, the green body, right? That is a wick. We call that the wick, right? We call it a wick, right? Vertical lines above and below the highs and the lows, right? So if you guys look right here on the right side of this green candlesticks, right? An example over here. So by open, when we say open, is we're saying that the bottom of the body, especially for a bullish candle, like a green candle, because it is green and the goal of green is that we are going up, we are going long, the price is rising. That means it opens, the body opens at the bottom. So you guys can see over here, it opened at what? An example over here that I use is price of 50, right? Can you guys see the price of 50? Let me see if I can get, the zoom annotation over here. So you guys I can mark things out and you guys can see it. Let me use a red color. Can you guys see the open price over here? And this is the open line, right? Can you guys see that? Yes, yes, yes. Can you guys see it? Guys, this is a point I want you guys to be participating so I know that everybody is watching me, right? Because we are getting to the heart of things right now. Yeah, in my guys, don't mind me if you're from Nigeria, you're from Ghana, if you're from any other part of the world, don't mind me, but you have something we call in our local parlance, as we get into things, that we get into the heart of things. Now we are going deep, right? Deep waters, right? So when we say, structure of a green candle, we say the open, right? That is the bottom of the body. And this is the bottom of the body, right? Here, where I've drawn the red line. And the open price, that means on this day, let's say that this candlestick is a daily candle, right? I want us to look at it from this point. Let's say that this candle that we are looking at over here is a bull. I want to see everybody comment. I've seen only 3 people only comment that they've seen the what I just showed right now. I want everybody to comment in there and say yes, so that I know everybody is following, everybody is tagging, because this is a very important segment that we are getting into right now. I want everyone to put in a yes that they have seen what I'm talking about and they are following carefully with open eyes, or the closed eye, open eyes, right? Yes. All right. So this is exactly where price open for this day, and keep in mind, like I said, the candle can be a day, it can be a 1 hour candle that is bullish, it can be a 5 minutes candle that is bullish, it can be a 15 minutes candle that is bullish. It doesn't matter. Wherever we look at it, we see that, okay, the price open from here. That's the open. And then where did it close? At the top of the body. So I'm going to use a different color, maybe a blue, right? This is where the price, closed. Can you guys see the blue line that I'm drawing over here? All right. And the price closed at what? $53, right? Can you guys see this? I want you guys to follow me carefully, guys. Follow me carefully. But when the price opened at 53, right? When the price opened at 53, guess what? Sellers jump into the market and they wanted to pull it down, right? They wanted to bring the price down over here. Can you guys see what I'm doing over here? They wanted to bring it down. And so they wanted to bring it to a price of what? $48, right? No, it is marked. Okay, let me use the tip of the wick over here. But sellers wanted to pull it down, and then buyers said, no, we're not going to allow you people, right? Buyers set into the market, and then they pull it all the way up here, right? Can you guys see it? Buyers got into the market, they pull it all the way up here to a price of what? 55, right? Over here, 55. But even as buyers step in and pulling down, still sellers were still doing their best. They were trying, and so they pulled it all the way down again, and then finally it closed over here at what? 53. That means the open price of 50, and then what? A close price of 53. That is what? A positive one, right? Because it did not close where it opened, right? So it opened at 50 and then closed at what? 53. As we can see. So price closed at 53, that is a closing price, right? That is what it is telling us over here. The structure, the open price, the bottom of the body, especially for a bullish green candle, right? Because green means we're going up. Red is not like green. Red is very different. We'll come to red very soon, right? So green, we open up here, right? We open up here at the price of 50, and then we close at what? 53. But there were attempts by, the buyers to take the price up, but they could not stand the pressure from the sellers, right? Sellers were also trying, but they could not, right? And then price closed at 53. What this means is annotated here. I've put it over here, right? Let me erase this. Let me get this out of here. You guys get what I'm talking about now. So let me get it out, right? Okay. This means that what? Price started at 50. Buyers push it up as high as what? 55, right? Sellers try to push it down, to 48, but that didn't happen. But buyers close it strong at what? 53. The candle body will be green, stretching from 50 to 53. The wick will extend to 55 and at the top, and then 48 at the bottom. That's a wick, the wick candle, right? So that is a price action over here, for this green candle as we see it, right? The opening price, the closing price, the high of that candle, and the low of that candle, right? Do you guys follow? I want to see a yes, yes, yes over there right now. I want to see a yes from everybody. I want to see a yes, yes right now before I go to the red one. Okay, all right. You guys are following. Okay, all right, good. And then let's go to the red candle as well, right? Let's go to the red candle as well. So the red means what? Sellers or bears were stronger, right? Anytime you see a red, we get into things, guys. We get into the heart of things, right? So red candle also means what? That sellers, it was a bear's market. Bears were strong. Price closed lower than it opened, right? That's what that means. Price closed lower than it opened. So when you look at the structure, look at the candle structure over there, the open price, top of the body, because anytime you see a red, that means we're trying to drop, we're trying to come down, right? So it open and then push down further, right? So the open is always at the top of the body, and then the closing will be lower, right? Lower, guys, keep in mind, anytime we have a pop quiz here, in our next sessions, future sessions, we'll just come over here and I'll just call somebody's name and say, why is, a bullish, a bearish candle, why the price lower? And you have to explain to me, right? That tells me that, you're following, right? So if you look at the structure, the open top of the body, close bottom of the body, and then wick, on the sides, right? The highest and lowest prices during that time. So as an example, you guys will see, I'll use annotation again, right? I'll use a color. Let me get a color, maybe blue to do the opening, right? So price open right here. Can you guys see that? Where's my pen? I need a big pen. Highlighter, okay. So price open right here. Can you guys see the 60? That is the open price. When sellers were getting in, they open the price from here, right? It's trying to sell from here. That's the open price. And then the closing price was what? 55. But guess what? Sellers tried, right? Even as price opened over here, buyers came into the market. They tried to push their price up, right? They're trying to buy. When they buy, that means they want to take the price up. But they couldn't because sellers were trying to sell down, right? So buyers even tried, and then they tried over here. So price of what? 62, as high of 62, try to move up, but it didn't happen. Sellers exhausted, right? The sellers exhausted, the buyers. And then they came to the open price and then even push it all the way down to a low of what? 54, right? You guys can see that over here. 54. And then they close it finally at what? 55, right? That is a closing price, right? So it doesn't matter the candlestick time frame, whether it's a 4-hour, 5 minutes, 5 seconds, 1 second candle, whatever. It's all red. We read it the same way, right? The open price, the closing price, the highest of that candle, the lowest of that candle, right? So what this translates into is that what this mean here is that price open at what? 60. The highest was what? 62, right? Trying to move up. And sellers were like, nah, not today. Not today. We're not going to give you guys a chance, right? Not today. And then the lows of what? 54. And then it closed at what? 55. This means price started at 60. Sellers push it down as low as 54. Buyers try to push it back up, right? Try to buy and push the price up. But it didn't happen at 62. But sellers close it down at what? 55. So the candle body will be red, stretching from what? 60 to 55, right? Guys, keep in mind, the numbers go up, right? If you're reading the numbers, right? 55, 56, 57, 58, 59, 60, right? So up and then come down, 55, right? So selling, it's always dropping, it's always coming down. This should not be very confusing. This is very easy for us to, read. This should be very easy for us to read, right? So open price and the closing price, very, very explicit over here for a red candle that is bearish, right? A red candle that is bearish, a bearish red candle. So let's look at, Michaela's, make money. Yesterday, how many people were here? How many of you enjoyed the Michaela's, lemonade business, right? Let me see a yes, yes, yes in there. How many people were here yesterday? You guys enjoyed Michaela's make money business, right? On how Michaela started from a street corner, and took her business all the way to Wall Street, right? Got an IPO. How many people were here yesterday? I want to put a yes, yes, yes in the comment, right? So let's look at a real life scenario over here of this, right? So imagine Michaela is selling lemonade, right? Michaela is selling lemonade, selling the juice that she started her business, right? Michaela's lemonade. And we have 300 people that want to buy, right? We have 300 people that want to buy. She runs out fast because she has only 100 cups of lemonade, but we have 300 people, right? So she runs out of what she's selling, and raises price to manage demand. So what's going to happen? Whilst there's more demand, to keep pushing the price up, right? That's how business is. People start coming, okay, price was to begin to go up. That shoots up the price. And so what we're going to see is that we're going to see green candle appear on the chart because there's more demand. A lot of people are coming in, more buyers. It's rallying up, going green, going long, going up. Everybody want to be in, want to get a piece, right? Price shoots up, green candle appear on the chart. This creates what? The demand, candlestick, right, on the chart. And then we all see that, right? And then the next day, guess what? Guess what happened the next day? On the next day, Michaela said, oh, yesterday there were a lot of people coming. So today, let me produce, she overproduced 300 cups. But guess what the next day? Only 50 buyers show up. To avoid waste, she drops the price to attract more buyers. Result is what? Price drops. Red candle on the chart, right? That's a red candle. Sellers were in control, right? Sellers were in charge. They were one that saying, okay, you need to bring the price down so we can buy. Sellers are in charge, right? That is what it looks like on the market every day. That is the different price action, the human psychology, and all those type of things that are moving around, right? So that is how things look like. That's how things look like on daily basis on the chart, buying and selling, and when to get in and when to go out, right? Imagine Michaela selling that lemonade that we have talked about. But there are types of, let me get to this and then that's it. We will wrap up here. There are types of what? Candlesticks, right? There are types of candlesticks. When you see this type of candlestick, right? Can you guys see this small red and then big green candlestick? Say yes, yes, yes for me. There are types of what? Candlesticks. Can you see that? Say yes, yes, yes for me. This candlestick is what we call bullish engulfing. Bullish engulfing, right? I'm just going to give you guys some few types of the candlesticks, that are relevant, that, appear. And again, I want you guys to keep in mind, I have a duty to let you know all these things, but we are not just going to trade you looking at the candlesticks and they say, we're going to enter into trade. No, but you need to do this. This is good foundation for you guys to know, right? Bullish engulfing, right? Bullish engulfing. What does that mean? A small candle is followed by what? A large green candle that completely engulfs it. It makes the red candle very small. It covers it, overshadows it, right? From the bottom part to the upper part, everywhere. That means that what? Buyers have taken control after a period of what? Selling. This means that what? Sellers enjoy their time for a little bit, right? And the buyers came in, they step in and say, I will show you that, we have muscles, right? We have strong muscles, right? So if you're a trader, the expectation that you look for price to move upward, enter the trade, on the next candle or the break of that engulfing candle high, right? So you look out for this, that, okay, once I see something like this on the chart, and you guys are going to see this a lot. Yeah, this is very common to see, right? This is very common to see. You see something like this. Oh, that's bullish engulfing candle. I see a red, and I see a big, explosive, green candle, right? Engulfing the small red candle. And then we have bearish engulfing. Can you guys see this as well? Put in it, yes, 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 yes for me, please. Let's wrap up strong. Let's wrap up strong for the day. We're getting to the top of the hour. We're going to wrap up strong for the day, right? I want you guys to, don't let me lose you, please. Let's everybody. I want everybody to be excited. Let's wrap up today's session strong, right? We have bearish engulfing, right? Bearish engulfing. You see a small green candle, and it's followed by what? A large red candle. That completely engulfs it, right? That is what? Bearish engulfing candle. You're going to see this a lot on the chart. You guys will get to see this a lot. Meaning sellers are now in control after buying pressure. Sellers are now in control, right? Expect price to move downwards. When you see this on the chart, then your expectation should be like, oh, this is big. That means this is sellers taking control of the market. That means, price is likely to move downwards, right? Price is likely to come down, right? But hey, you don't just look at this and start selling or looking for a sell opportunity, a trade. No, you cannot just take this in isolation. We don't do that, right? There are a lot of things that we're going to add to this for us to be able to what? Take a trade, right? So be patient, guys. Be patient. Don't go into it. I told us yesterday that, when I see a bearish engulfing candle, that means, sellers are in control. So let me buy, right? Let me sell, right? Because, sellers are now in control, and they will exhaust and overwhelm, the buyers here. No, please wait, right? This is not a time, right? So bearish engulfing. And then we have something we call hammer, right? We have a candlesticks that looks like this. It's called hammer, right? You guys are going to see this a lot. It's called hammer, right? Hammer. And this type of hammer is called reversal bullish, right? Hammer. It's a small body at the top with a long lower wick, right, of the candle. A small body at the top with a long lower wick. When you see this, what does it mean? It means buyers rejected lower prices and closed near the high. Buyers what? Rejected lower prices and then closed near the high, right? It means there's something happening, right? What should be your expectation as a trader? Bullish reversal signal. That means stronger when found at the bottom of the downtrend. All these things, we're going to get into trends and other things. We will put all this together. It will all align very, very well, right? So that's the hammer. And then we have the inverted hammer, right? This is another candlestick called the inverted hammer. Small body at the bottom with a long upper wick, right? Small body at the bottom with a long upper wick, right? Means sellers try to push lower but failed, right? Sellers are trying to push the price down, but they feel potential buyers, buying pressure ahead, right? When you look at this, means sellers are trying to push it down. They're trying to push it down, but there are buying, signal over here, right? So may indicate a bullish reversal. Look for confirmation from the next candle that will appear. So when you look at this, something like this appear. Look for another green candle that will appear to give you confirmation that maybe there are buyers now, right, in the market. And then we have something we call shooting star, right? This is the anatomy of the candlesticks, guys. This anatomy, right? Anatomy of the candlesticks, right? We have a candlestick type called shooting star. Shooting star. This is a reversal bearish one, right? Shooting star. A small body at the bottom with a long upper wick, right? The candles are very, very different, right? They might look very similar, but they are very different, right? Buyers push price up, but sellers took over before the close. So expect a downtrend pressure of it if confirmed by a following red candle. Typically, if you look at it, you see a red, like the bearish one, the shooting star bearish, versus bearish. And if you see another red candle, that means, sellers are coming in. And then we have the doji. There was a candlestick called doji. D-O-J-I. Doji. When you see it, that means there's indecision, right? There's a lot of indecision on the market. There's a lot of indecision on the market, right? That means, the open and the close are almost equal, whether it's green or red, whatever. If you see a doji candle stick, it's almost the same. Where they open, where they close is almost the same price, right? That means there's indecision. They don't know what they want to do. When you see this, that means that these people they don't know what they want to do on the market, right? They don't know, indecision, right? It could be a potential reversal, it could be going up, it could be coming down. Market is undecided. Neither buyers nor sellers are winning. Nobody, right? There's doji. Doji, guys. When you see a doji candle, you have to be attentive, pay attention, wait for confirmation, wait for what comes next, right? It may signal reversal if found at a stronger trend, right? You know, that's a doji candle, right? Doji candlesticks. And then we have a morning star, right? The morning star is like a 3 candle pattern. You see 3 candles together, morning star. So we have the bullish morning star. You see a red, you see a green that is like at the middle center, down a little bit lower. And you see a green candle, very big one as well on the right side, right? That is morning star. We call this candle morning star. We have an evening star, so it's coming very soon. Morning star. So red candle, small body candle, that's doji spinning top, large green candle, right? Meaning what? Meaning selling pressure fades and buying takes over, right? If you see this morning star, that means it's going to go good. Why? Because it might be time to buy, jump into it and buy, because buying, buyers are taking over, right? Strong, take over by the buyers. Guys, I said it. Candles, they tell a story, right? There's always a story behind every candlestick that you see, right? Trade expectation, strong signal for upward reversal. So strong signal to go up, right? When you see a morning star, right? When you see a morning star candle. All right. How about an evening star? If you see an evening star candle, what does that mean? Bearish, right? Evening star. You see a green candle, a small body candle, and a large red candle, right? Large red candle. That means what? Buyers are exhausted. Sellers stepping in, right? That means buyers are being exhausted. They are overwhelmed. They are overwhelmed, right? Sellers are stepping in. Watch your expectation. Watch for a price dropped. Watch for a price dropped. Strong when found after an uptrend. Typically, you will see an evening star when price rallied up, it goes all the way up, 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 and then once you see that evening star and you know that it's about to go down, right? You see the evening star, then you know that sellers are taking over the market. Sellers are about taking over the market. All right, the last one is going to be an inside bar. Oh, why my image did not save. I'll try to get an image for you guys for inside bar. So inside bar is a continuation of reversal. A smaller candle forms entirely inside the range of a previous candle. So you will see a candle and then a candle will form in that range. That candle that has formed after the previous candle, it is not bigger than the previous candle. It is forming in the range of the previous candle, right? So that means market is pausing before a big move, right? So what should be expectation? Wait for a breakout above or below the mother candle, right? The previous big candle. And then use the trade breakout or trend continuation, to sort of make a determination whether you should go long or whatever, right? That's the inside bar, depending on what you are seeing, right? That's the inside bar. Guys, we made it. We made it. We made it. We made it. We made it to the end of today's session, right? Wow. We have 5 more minutes. Do you guys want to take the assignment, or you guys want to take the assignment next week? Because I want to be able to answer some questions, but we have 5 more minutes. Do you guys want to take the assignment? The assignment will require that I have to also set everybody up on TradingView. If you were on the demo session the last time, then you should have TradingView already set up. How many of you have your TradingView set up already? Let me see. Yes. If you guys are ready. Let me see how many of you have their TradingView set up. Say yes. Yes, for me to know. If you were on demo session, I help you guys set up the last time on the demo session. Yeah. So I have just few people, only 1 or 2 people that have TradingView set up. Okay. we will do that, next week then, because I don't see a lot of people. Yeah, I don't see a lot of people with their trading view set up, and that's gonna take about 15 minutes for me to help everybody set up, because I will let you set up and then share your screen so that I know that you're on the right track, and then after that I will share a watch list. And then your assignment is to go and find, I've listed some of the candlesticks that we talk about. I want to train your eyes to see these candlesticks, right? So, bearish engulfing, bullish engulfing, doji, all of that. Morning star, evening star. I'll let you guys go and find. But first of all, I need to help you guys set up on the trading view first, and then I will share the watch list. You guys will add the watch list to your watch list on trading view, and then you guys can do the assignment. But since you guys don't have it, then we'll take that next week, right? We'll take that next week. Next week, our starting point, we'll be getting into tools and technology. So we'll start with trading view. I'll help you guys build a trading view, and even help you guys set up some few favorite tools, etc. You build your favorite tools, the tools that you're going to be using very commonly as well. And then you guys will do the watch list as well. I'll share a watch list with you guys. We'll take that as well, and then we get going. So this week, it's almost like we get into chatting, right? We get into chatting, but there are a lot of things that we also have to cover. So we do that a little bit, and then we get into curriculum. We do that a little bit. We get into curriculum. There's a lot of things to cover, right? All right. So guys, that is going to be it for today. That's going to be it for today's session. Next week, Saturday, you guys already know the time, 6 a.m. to 9 a.m., right? I'm going to see you guys. All right. 1 minute for questions. Question, anybody? Any? Before we go. Any question before I sign out here? Any question? Everybody's good? Let me see the chat box. Good. Let me see the chat box that good. So that I know everybody's good. Let me see the chat box. Good. From everyone. Good. Let me see the chat box. Good. Everybody's good. Okay. So you kind of got confused between the red and green. I'll come to that. It is not about desiring. We don't desire anything here, right? We are not waiting to see like, oh, this is what I want to desire. I want to look for. Green is what I like, or red is what I like. No, green is basically a buying, right? Buyers are in charge. That's green candle. Red means what? Sellers are in charge, right? They are selling, right? Basically, so that's what that means. So, for instance, when I bring this chart up here, on the Nasdaq, right? When I bring this up here, guys, it is not about what we desire, what we want to see. I want to see green. I want to see more of green. No. When I bring the chart up here, you should just know that green is here. Oh, okay. All right. That means sellers. Red is here. That means sellers. Green is here. That means buyers, right? They were buying, right? Bullish, right? The red means bearish, right? That is what that means here. Yeah, the candlesticks will come, the hammers, the red hammer and the green hammer. I'm thinking you would price to go up after buying it low. I'm thinking that you will want the price to go up after buying low. Yes. When you buy something, your profit is going to be determined by how high it will go, right? If you buy, that means you want it to go up. If I buy something right now, let me see if I can get something to buy right now. Let me see what is happening on the market right now. Let me use that as an example. Right. If I buy something right now, let me play with this one. What is this one? Okay, long position. Let me take a long position right here and see if it will work. If I buy something right now, I expect the price to go up, to move up. So because when it move up, that's where I'm going to make money, right? I'll not make money if it's not moving up. It's already moving. I wanted to use this as an example over here. I want to see if you can get something. So your profit is going to be in the move out, right? I wanted to buy something quick. Hopefully, to move up for us to see, oh, it's coming down, right? If it moves up, you guys will see that, I'm in a trade right now. That means it moves up. This will change. You guys will get to see that, oh, okay, now my profit is coming. So the more it moves up, that is how I'm going to be making money, right? So if I buy something, my expectation is that I want price to move up. If it doesn't move up, I'm not making money. Okay. Now I'm in a trade right now. It just took my trade off the buy. I wanted to buy something. It took a trade, but it's not moving up, so I'm not making money. I'm already in minus $25, right? Now, if it moves up beyond the entry point that I entered the trade, you guys will begin to see this as a positive number. That means I'm in positive down, and my expectation that it will continue to move up, and maybe hit maybe take profit, my target over here, right? If it comes up here, then you guys will see that. Do you guys see that it changed a little bit when it tried to come up? It changed to 0.50 or whatever cents, right? As green, right? So if you buy something, your expectation that it will move up. Now, if you sell something, your expectation that it comes down, right? It will drop. It will keep dropping. Sell means dropping, right? Sell means let it drop, and then buy means up. You want it to go up, right? This is very easy. When we begin to build our tools next week, we begin to practice on some of these things, right? You begin to practice, and you begin to go long and go short and do all of that, right? With different trades and different things like that. Next week we'll begin to, see a lot, with that. It's very easy, buy means up. You want to trade to go up. Short means you want to trade the price to drop. So that the more it is dropping, that is how you'll be making money, because you are shorting the market, right? Shorting means, your expectation that price is going to come down. And so as it's coming down, you are shorting the market and you're making money with it, right? That is what that means. All right. Next week, when we build our tools and we're going to play a lot with some of these things, right? We're going to play a lot. And once we play a lot, you guys will begin to see a lot of movements, a lot of traction. You guys will begin to see a lot. So like this one, let me first see. I wanted to see if I can get something on a short quick here, so that you guys can see the example of the short as well. Or if I can enter it quick before the price move. Oh, it's even going up. Let me see if I can enter a trade for short quick. Let me see if I can get a bid or ask price of whatever they're asking for. 231,656, 231,652. It wants me to buy at the very bottom. Oh. Let me try something else over here. UPNZD. I want to give you guys a shot, but it's essentially the same. We'll try some of these examples, and you guys begin to see it. So, the forex market is open. I see all this currency market is open. GGP card, they are all open. They are moving. There are a lot of movement going on, right? A lot of movement going on right now. If you're shorting, short the market, if you want to buy the market, you can buy the market as well. If you want to buy the market, say, hey, I want to buy the market, you can buy at the market price, but we're waiting. Now it's in negative as well. This is another example of what we're talking about. If only price come down, it drops because we are buying. I say we are buying. We were selling. If price drops, then that is how we're going to make money, because our expectation is that I bought it at the market price, and my expectation is that it's a sell order. So if it come down, then I'm going to be making money, right? I put my entry somewhere far away from where the price was, right? You guys see that stop order has executed. This is a classic example, right? My stop order was placed here. And I say, if price goes beyond that, take me out, right? In this example that we are playing with, right? And the stop order executed. It took me out, right? My stop order was whatever, I forgot the amount. But price, behaved like it wanted to go up. And then what? My stop order was taken out. That is a classic example of what we were talking about with stop loss. But again, there's going to be a lot of example, like what if you do, you're going to play with this, right? You're going to play with paper money a lot. A lot of examples that we're going to be looking at. All right. Okay. All right. I think that's it. Any more? All right, guys. So that is it for today. We will meet again next week. All right. Bye.